fulcrum of this market has been big tech.
We are still in the early stage of this AI investment or AI arms race.
We actually see going into 2026 a very optimistic scenario playing out.
The air is coming out of the bubble rather than the bubble bursting.
To call this a bubble, it's wrong.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance in the last month of the year. Futures dipping after the longest string of monthly gains on the S&P 500 going back to 2021, although ongoing worries about the dominance of big tech. Kicking off the holiday shopping season with some positive signals from the U.S. consumer, despite confidence falling to a 7-month low. And President Trump moving closer to choosing a new Fed chair. Kevin Hassett taking the pole position, a wink, wink, nod, nod. Kevin Hassett talking about how the market seems like it's happy. Getting a sense, maybe we'll get an announcement soon.
Right. Kevin Hassett over the weekend talking about what we saw in the market response to what he called the Bloomberg report. A rumor was that the market was happy as he described the fact that the president is closer to making a new announcement, that there will be a new Fed chair come next year. We heard from the president overnight as he made his way from Palm Beach back to Washington, D.C., was he said, I know who I'm going to pick, and we'll be announcing it. This is what he told me, though, 2 weeks ago when I was in the Oval Office with him. Yeah, I have an idea of who I'm going to pick. I know who I'm going to pick already. The interviews are going to be starting soon. The Treasury Secretary says we will likely get a name before Christmas. So once we get that interest rate decision, potentially we'll get a name. Or if we really want to see fireworks, potentially we get a pick before the Fed meets.
Regardless, the market is taking this as a likely December rate cut, and that's what matters. Dovish Fed, and that's the reason why people seem to be cheering. That's why people were cheering last week. That's why you saw a risk reversal back to a positive after a pretty dismal first couple of weeks. The interesting thing is, this would be jobs week. We would be getting jobs data come Friday. We're not. So we don't have a sense of whether the underlying economy actually warrants a Fed rate cut that everyone's baking in for next month.
A data-dependent Fed, this puts them in a really difficult position. But when you hear from Fed officials, especially when we heard from John Williams, and that is really talking about this trend and this idea, and there does seem to be now at some point a bias towards the labor market, you immediately saw the market really start to shift. What's going to be more challenging, what a lot of analysts are talking about, is this division on the Fed and where neutral is. So what sets them up for 2026? Do we get more cuts, or do some individuals think we are at neutral and they should just stay the course and leave interest rates on hold? At the same time, the president's going to potentially be putting someone in that wants to see further reductions.
And it really is about vibes and feelings, because right now it's not about hard data. The week ahead, we should be getting non-farm payrolls. We should be getting JOLTS data. We should be getting all of this other anecdotal senses of what exactly is going on with the consumer. Instead, we're getting ISM manufacturing later today at 10 a.m., which could give you some sense. Later this week, we do get ISM services as well as the ADP payrolls report. Thursday, we get initial jobless claims plus challenger jobs cut. That actually might end up being something that is market moving. And Friday, we get September data regarding core PCE spending and income. Nonetheless, people really looking at what's going to happen with Black Friday. Right now in markets, you can see a little bit of a dip after the 7th straight monthly gain of the S&P 500. Right now, S&P futures lower by about 0.6%, a bigger underperformance from the NASDAQ with those ongoing AI-related fears. 10-year yields just up incrementally higher. A focus right now on Japan and a Bank of Japan rate hike. 10-year yields 4.04%. Coming up this hour, Alastair Pinder of HSBC with stocks sitting near all-time high as Robert Koenigsberger of Gramercy Funds as the U.S. ramps up pressure on Venezuela, and Sonja Marten of DZ Bank as President Trump says he has made his pick for the next Fed chair. We begin this hour with stocks lower as investors wait a crucial week of data. Alastair Pinder and the team at HSBC setting their 2026 S&P 500 target at 7,500, writing, AI has carried equity markets throughout 2025. We believe it will drive both equities and credit in 2026, though in different ways. Alastair joins us now after a refreshing Thanksgiving break that all of us cannot relate to. But I am curious from your perspective going forward, how come you think that AI is going to resurrect that kind of lead higher, given some of the concerns that we've seen recently?
Well, I think if you look at the performance of the market this year, it's been driven by the AI infrastructure and, the AI enablers story. Going into next year, I think the big narrative for markets is how companies are going to adopt AI, and that's going to drive earnings. And so there's loads of data showing this. Some of the ones that we like to look is the Ramp AI Index shows 45% of companies are adopting AI. One of the things that we've been doing a lot on is, well, what is the actual tangible cost savings from this? And so far, we think that there can be basically 1% of cost cuts going into next year. That's $130 billion. We think that can basically be saved going into 2026. And there's this amazing narrative going on right now in the market where revenue's increasing, you've got 9% growth. Actually, at the same time, companies are cutting back on labor. And so if you look at the warm data from the S&P 500 companies, it's been shooting higher. But this is nothing, absolutely nothing to do with them warning about the economy. Actually, their corporate guidance, earnings revisions are, close to all-time highs. So this almost, for me, feels like a Goldilocks scenario going with the, the AI narrative going into next year. And my final thing, if you have a little bit of labor weakness as a result of AI, then going back to your conversation about the Fed, might that not keep the Fed a little bit more dovish? And that, I think, again, can help support the equity market rally going into next year.
Goldilocks for the equity market, maybe not the economy, which is a sort of key distinction here. I do wonder, so this is an argument for AI being dominant, but that means the rest of the 493 outperforming, playing catch-up with the Magnificent Seven. Is that correct?
Correct. And again, one of the biggest things that we've seen over the last couple of years is that actually the performance of the Mag 7 has not been driven by valuations. It's all been by earnings growth. And now what we're seeing is earnings growth going from roughly 30 to 40% year on year into next year, probably being in high teens, and the rest of the market actually catching up with that. And so this will be one of the first years, really since 2021, where earnings growth between the Mag 7 and the 493 are going to be somewhat equal. And so I do see much more scope for, outperformance for the rest of the market.
What for you will be the telltale sign that actually adoption is underway significantly in some of these industries?
Well, I mean, to be honest, I already think that we see that. I mean, if you look at the data from some of the consumer stocks that are basically saying that we're using AI and becoming much more productive in terms of, targeted ad sales and whatever else, a number of companies on their earnings calls are discussing about how they're adopting AI and actually, again, replacing that, labor or freezing labor as a result of the higher productivity. To me, we're already seeing it from companies in the earnings calls. Now, you have to talk about the equity market and the economy. What's very interesting is that for the broad economy, I don't think we are seeing much productivity increase. It's really the large cap stocks. And so again, where does this AI productivity come from? It comes from companies with huge amount of employees that need to reduce it. If you're a small company and you have 10 employees, you're not going to really replace that with AI. But if you've got hundreds of thousands of employees, actually that's where the cost benefit comes from.
You mentioned that this means maybe the Fed then has to be dovish, but how could a Fed interest rate cut cycle solve the problem of AI?
In terms of, I mean, it doesn't really solve the problem of AI at all.
I mean AI labor layoffs.
Yeah, exactly. I mean, it doesn't solve this really, but it does reduce some of the pressure on the labor market in the near term, right? In terms of reducing, credit costs, reducing interest rates, reducing some of that burden on the low-income consumer. And of course, it is the low-income consumer in particular which has been hardest hit by higher interest rates, given that they have more of their debt in sort of floating rate debt products like, auto loans, credit card loans, rather than mortgages.
At this point, it sounds like everyone's banking on stimulus coming from the fiscal side with potentially $2,000 checks or whatever else comes from the tax refunds that we get in January. We're expecting monetary stimulus when it comes to Fed rate cuts, possible use of the balance sheet. I just wonder if this makes the U.S. a less attractive place on a sort of currency-adjusted basis for equities based on some of what we're expecting to see on the fiscal side.
Totally. I totally agree with that. And actually, one thing that I think the market is missing a little bit is it's not just stimulus that's coming out from the US. Actually, China's just done a $1.4 trillion debt swap. Germany is coming in with $150 billion stimulus next year. Japan is teeing up $110 billion stimulus next year. So actually what you could see is that you get a huge global wave of stimulus. As you mentioned, actually the dollar starts to weaken and the rest of the world starts to look very attractive, particularly because valuations are at a 30-40% discount. Even on the AI plays. You go to Asia, you got an AI discount there. In Europe, less so. But you've still got places like Germany, which are seeing 14-15% earnings growth and at a valuation of 14 to 15 times earnings. To me, that seems quite attractive at this point.
So what equity markets do you like? Germany and Asia plus the United States?
So we are overweight emerging markets. That includes Asia, LATAM. That's all due to huge decreases in cost of equity and interest rate cuts. But yeah, Europe, Germany also stand out as our key overweights. And the US we're neutral on. And a part of that really is because if I was going to get my AI kind of tech play, I'd actually rather do it with emerging markets rather than the US at this point. Again, just from that valuation perspective.
Lisa mentioned what's coming out of Washington in terms of the fiscal stimulus. How are you thinking about the potential tariff impact, whether it's the United States or globally, because we're still waiting on the Supreme Court decision on the president's signature tariff
Yeah, I mean, I think that is one of the aspects that worries me the most going into next year. So, I mean, the three risks, obviously, AI bubble and, the Fed being more hawkish, and we kind of discussed that. The tariff one, I just don't think we've discussed it enough. I think everyone thinks that we've moved past tariffs and that's never going to come to bite. I do think there's been a lot of stocking up on inventory. And I do think we're starting to see incremental signs of inflation actually come through. We haven't had a lot of inflation data. And I suspect actually when we get it, what we're going to find is that actually, particularly on the good side, there's been a lot of pushing up there. And so I do wonder whether that starts to eat a little bit into margins. But this is where I could say AI comes to save the day. Because on the one hand, if you're a company and you're facing higher costs, actually, I think the big incentive for as a company right now is, okay, why don't we adopt AI and try and reduce cost savings that way? And so much like COVID was like one of the biggest forces of innovation and adoption for companies, I actually wonder whether tariffs is one of the biggest forces of adoption of AI this year and next year, because it forces people to become more productive.
Does it make you nervous that nobody else is bearish?
I mean, I talk to people that are bearish. I think you can speak to...
Are they enacting their bearish beliefs, or they just sort of feel negative?
I think there's two things. I think the sell side, including myself, is quite bullish. I think when I speak to investors, they're clearly a little bit worried about this. I think there's definitely, every room that I walk into, it is, are we in an AI bubble? That is the number one concern. And then again, actually, this conversation about the impact on labor and, will the consumer roll over more aggressively next year is probably the second biggest concern for people, for investors at this point. So, do I think everyone's bullish? No. I think there's actually a huge amount of money on the sidelines. And one of the things that I think is, again, really important here is that there's $3.5 trillion of cash sitting in time deposits. Just retail investors, cash, $3.5 trillion. And as the Fed cuts interest rates, that's going to unlock a lot of that cash, which can go into the equity market still. So I still think there's a lot more buying opportunities and money to go into the equity markets here.
Alastair Pinder, thank you so much for being with us. That's Alastair Pinder of HSBC. We had been tracking Airbus earlier this morning on news over the weekend that a majority of its A320 jets received modification. Reuters currently saying that Airbus faces new quality problems on dozens of A320 jets. And you are seeing, Annmarie, a real shift lower in Airbus futures, down 7.3% as people wonder, what else are we missing?
Well, yeah, exactly. We had earlier this morning that the vast majority of these jets were impacted by a software glitch. Now, Reuters is saying there's a new quality problem on dozens of them. This is going to weigh on the stock like we saw with Boeing. This takes a lot of time to unpack exactly what's going on, and potentially, as we've learned from the past, potentially more damaging news is going to drop as we understand what's happening with these jets.
Yeah, we'll follow this throughout the morning for you. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Good morning, Lisa. Thank you. President Donald Trump is downplaying his social media post that called on airlines to consider Venezuelan airspace closed. U.S. forces have been massing in the region as Trump weighs military action that would go beyond strikes on suspected drug boats. Venezuela's government called Trump's remarks hostile and demanded, quote, unrestricted respect for its airspace. President Donald Trump says he has decided on his pick for the next Federal Reserve chair, and he's made it clear he expects his nominee to cut interest rates. Sources telling us here at Bloomberg, Trump's chief economic advisor, Kevin Hassett, is seen as the likely choice to succeed current Fed chief Jerome Powell. This all, of course, according to people familiar with the matter. U.S. consumers staying strong. MasterCard says Black Friday sales rose compared to a year ago. Sales, excluding autos, increased more than 4% on the day after Thanksgiving. Online sales dropped compared to last year, with many shoppers saying deals were more muted compared with last year. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, escalating tensions with Venezuela.
We consider Venezuela to be not a very friendly country. They sent millions of people, really, and probably a number in excess of that.
Does your warning mean that an airstrike is imminent, or should we not read it that way?
Don't read anything into it.
Robert Koenigsberger of Gramercy Funds Management joining us next to make the sense of this from an investor's standpoint. This is Bloomberg Surveillance. Good morning. off the official start to the year with a little bit of softness, although we did grind higher for a seventh straight month in the S&P 500. Right now, dipping about 0.6% on the S&P. NASDAQ underperforming yet again after seeing a break in a 7-month rising streak. Last month falling just by a bit. The Mag 7 still leading the declines, down by 0.7%. The Russell 2000 also lower. Key to watch some of the anecdotal data coming out this week, given the fact that we do not get non-farm payrolls on Friday. A big bet, though, going on in the bond space of a Fed put, some sort of reprieve. The idea of a Fed rate cut in December has gone up to almost 85% from some 25% just a few weeks ago. And right now you are seeing a little bit of a lift, but still contained yields pretty much across the board. 30-year yields, though, inflecting higher by about 4 basis points, 4.7% rounded up. And the euro dollar, interesting. A question of whether we are seeing the reignition of dollar weakness, euro strength on the expectation for an easy policy from monetary side as well as fiscal side. Under surveillance this morning, geopolitics very much in focus, escalating tensions with Venezuela.
We consider Venezuela to be not a very friendly country. They sent millions of people, really, and probably a number in excess of that. And a lot of those people shouldn't be in our country, from jails, from gangs, from drug dealers, from all of the people that came into our country shouldn't have been in our country, causing a lot of problems.
Does your warning
and drugs.
Does your warning mean that an airstrike is imminent, or should we not read it that way?
Don't read anything into it.
Here's the latest. President Trump confirming he held a call with Venezuelan President Nicolas Maduro as questions mount over recent U.S. airstrikes in the Caribbean. Joining us now is Bloomberg's Mika Solner for more. Mika, I just want to start with what we understand about what's going on and where we stand with respect to potential action from the U.S. against Venezuela.
Absolutely. The Trump administration has been extremely aggressive in its posturing towards Venezuela, blaming it on targeting their narcotics operation. As we just saw, the president has been very vague on exactly what his plans are in that region. But there's been a lot of questions raised by members of Capitol Hill, Republican members as well, in terms of the legal actions that the administration has taken and what the next steps could prompt.
I do wonder, Mika, do we have a sense of what that strike was over on offshore of Venezuela? It was in the Caribbean. Big questions now swirling in Congress about the legality of it. What's the latest on that front?
Yeah, there are a number of top Republicans on Capitol Hill, from the top Republican on the Senate Armed Services Committee, Roger Wicker, to many prominent House Republicans that have, asked about the legality of the most recent strikes. But this has been ongoing, and these are questions, and the administration has been very tight-lipped on this, even in their discussions with lawmakers and those in their allies, and have kept it, very secretive in terms of what exactly their plans are.
Mika Solner of Bloomberg, thank you so much for that. Robert Koenigsberger, founder of Gramercy Funds Management, a global leader in emerging markets, writing, "It is so hard to imagine that the art of the deal leads to something short of Maduro ceding power. The path to de-escalation has become quite narrow." Robert joins us now. Robert, thank you so much for being with us. How are you understanding this from an investment standpoint about what U.S. involvement with Venezuela looks like now and what it will look like, say, 6 months from now?
Sure. Good morning. I think you need to break it down into a couple pieces, which is one, is there going to be regime change? What's the motivation of regime change? Then if there is regime change, what does that look like? And then ultimately, what does, what's the environment look like in Venezuela post? So from where we stand today, I mean, I believe, we at Gramercy believe the motivation is less about democracy and the stolen election from 2024 and more about narco-terrorism and quite frankly, taking back the Americas. There was the Monroe Doctrine, then there was the Roosevelt corollary, and now we've got the Trump corollary. So this is bigger than just a stolen election last year. And I think the way that this narrative has played out will play well with MAGA. And I think that was always a concern. I don't think MAGA cares about democracy in Venezuela. They do care about 8 million Venezuelans who have immigrated, a great deal that have come to the U.S., security, what have you. So then, we believe this is more than just regime change. We believe that Trump and Rubio have, bigger aspirations in mind. This isn't just about, a show of force in the Caribbean and then move on. But then to your question of regime change, and, we at Gramercy spend a lot of time thinking about what might regime change look like. There's capital R regime change, which I think many would like to see, which is, the Maduro regime leave, the Chavistas leave, and Machado and her people come in, capital R regime change. That may be difficult. We may see something more like small R regime change, where it's some sort of government transition where the Chavistas and the opposition still collaborate towards new elections.
What do you think the timeline for all of this is?
I mean, it's so difficult to say, but as you saw in Eastern Europe when the wall fell, so to speak, regime change takes longer than you think it's going to take, and then it happens faster than you thought it would happen. So, there's a lot of metal in the Caribbean right now. Would be surprised if we're in the same position at the end of the first quarter. Be surprised to see this status quo at Easter. But it's really hard to tell.
You talked about narco-terrorism, you talk about immigration. For the Trump administration, is this also about China and its encroaching on U.S., what the U.S. would probably view as its sphere of influence in South America writ large?
Absolutely. I mean, I think, the evolution of globalization is back towards regionalization and, as you say, spheres of influence. And, I referred to the Monroe Doctrine, and that was about, the Americas for America, if you will. And then the Roosevelt corollary went further and said, we will intervene militarily in Latin America to protect ourselves. So I think what the Trump administration is focused on is just what you said, which is getting the Chinese and their influence out of the Americas, getting the Russians and their influence out of the Americas, and going back to a world of spheres of influence where, maybe we'll be less focused on their region and more focused on our region. And who knows what the deal was in Alaska between Putin and President Trump as it related to Ukraine versus the Americas. But, Russia's been pretty darn quiet. China's been pretty darn quiet.
Robert, does this make you want to invest more in Latin America or less?
In Latin America, I mean, I think there's a lot of different opportunities in Latin America. I mean, for us, we've been more focused on private credit rather than public credit. But I think, as many have started to realize, emerging markets isn't necessarily more risky than developed markets. And we're seeing plenty of opportunities within Latin America. I mean, Venezuela's, there's very few ways to express interest in Venezuela. I mean, most of it's through the external debt at the moment, which is, I think, up 3 times since the bottom.
You said something there that I think a lot of people are going to find interesting, which is that you think that emerging markets might not be more risky than developed ones right now. It's something people have been flirting with. Are there dynamics in the developing world that you're seeing take hold in places like the United States or Europe that you find concerning and that you think that emerging markets in some ways is almost a reprieve from?
Sure. I mean, I grew up when we had 2 worlds. We had developing markets and we had emerging markets. I think today we have developing markets, emerging markets, and submerging markets. And it's the developing markets that are moving right to the submerging markets. And the things that we saw in the 80s and 90s that concerned the world about emerging markets, we're seeing about developed markets. Quite frankly, large debts, large deficits, and what have you. The emerging markets never had the flexibility to not adjust, to when COVID happened and what have you. And their fiscal houses are generally in order. Now, of course, emerging markets is a really big label. It's not a homogeneous asset class, nor is developed markets, but we're quite constructive on EM.
Gramercy Funds Management founder Robert Koenigsberger, thank you so much for being with us as we do parse through what's happening. I do wonder, Annmarie, from your perspective, how much some of the latest developing news around Venezuela, around that strike on the boat offshore of that nation, seems to be potentially having ramifications in Washington, D.C.
Well, I think a lot of senators want to get to the bottom of is actually what was ordered by the defense secretary after this really scathing report from the Washington Post about the strike and the subsequent secondary strike that existed when it seemed like 2 individuals were still alive and they had a secondary strike. When it comes to Venezuela, I recently caught up with Mike Wirth. He talked about being there for the long term and rebuilding that economy. When you hear from Robert, it does seem like that's where they are as well, and that this administration certainly wants to see a huge change in that country.
Yeah, rebuilding potentially some of the Latin American potential allies, as well as rebuilding the infrastructure around energy, potentially for artificial intelligence. Coming up, Ian Harnett of Absolute Strategy Research on the controversies facing investors in 2026. This is Bloomberg. coming after the seventh straight monthly gain for the S&P 500 this morning, taking a little heat off that. We did see a monthly loss for the NASDAQ for the first time going back to March, 1.4% decline. We are seeing that decline extended, which really is notable given the fact that people are wondering whether this is a rotation or whether this is a bubble that is starting to burst. And the Russell 2000 futures down almost 1%. With a real question on the consumer, yes, they're spending, but is it enough? And is it enough for the bond space, 2s, 10s, and 30s? Is there a question of how far the Fed can cut, about how aggressive they will be as President Trump talks about choosing a new Fed pick? We now have more than an 85% chance of a Fed rate cut come this month. Right now, 3.5% on the 2-year, just up about 4 basis points on the 30-year to 4.7%. And you believe that in the currency space, what you get is a weaker dollar as people expect an easier Fed and potentially deteriorating economic data. Euro at least rising. Maybe it's just a reprieve after a lot of negativity around Europe. 116 right now. 3 hours away from the cash open. Here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. As you mentioned, we're seeing a real risk-off mood to the market this morning as we start the weekend. It's showing up in Bitcoin, falling as much as 6% earlier to below $86,000, though we have recovered some of that since then. And most of that having to do with the risk aversion we're seeing in markets, but also China's central bank saying it plans to clamp down on cryptocurrencies. And that is hitting stocks like Coinbase, MicroStrategy down 4%, and Bitmine down 6%. Meanwhile, over in Europe, we are seeing Airbus shares falling more than 8% now in the pre-market on a Reuters report that the plane maker has run into quality issues with fuselage panels on dozens of A320 jets. Remember, those are the same jets that suffered a software glitch last week that affected 6,000 planes, though that has now been fixed. But this is all coming as Airbus races to meet tough delivery targets it's set for this year. And we end on Canadian solar. Those shares are moving to the upside by 11% in the pre-market after it said it's moving control of its Chinese factories to Canada in an effort to avoid U.S. tariffs and also keep it on the good side of U.S. regulators as it wants to continue selling into the U.S. market at a time when we know Washington is clamping down on clean energy imports from China, an area that, of course, China dominates. Lisa.
Thank you so much, Yahaira. On our radar this morning, U.S. and Ukrainian negotiators saying they had a productive discussion about a framework for a peace deal this weekend down in Mar-a-Lago. Secretary of State Marco Rubio saying there's more work to be done. A special envoy, Steve Witkoff, heads to Russia today. Meanwhile, U.S. consumers demonstrating their resilience as the holiday shopping season kicks off. Black Friday sales increasing over 4% from a year ago, despite economic concerns. Today is Cyber Monday. Tomorrow is I don't know.
They're all blending together.
Ticket Tuesday.
So many people are buying their Black Friday sales online. So I feel like Black Friday, Cyber Monday is all merging together, which is why I find it almost shocking that consumers spent a record $11.8 billion online on Black Friday online, when basically you're going to have the same deals potentially on Monday. I just want all the emails to stop. I feel like it is just spam overload from the retailers. I understand it's percentage off, but okay.
I think they're all personalized. Or Annmarie, please come in. We know what you like. Here's all of the list of things.
And then guess what? We're giving you another 24 hours. We see that in your cart. Okay, I left the cart as it was. I'm not buying it.
Well, but this to me actually does highlight, is this a sign of strength or is this a sign of weakness? We're talking about this as a resilient consumer. At the same time, who's buying? What are they buying? How much are they waiting to buy for the deals, not necessarily buying earlier? And how much is this on an inflation-adjusted basis, not nearly as good as it looks? And I know that it sounds like Debbie Downer, but this is kind of the tea leaves that people are looking for in the absence of that holistic data that we normally get out of the Bureau of Labor Statistics.
Absolutely. I think you nailed it. This isn't inflation-adjusted. So it almost feels like maybe it's flat from where we were last year. And if you look at what the Fed Beige Book talked about, it's the lower end consumer that is really struggling. How much of this 11.8 that's being spent is actually just from the higher end cohorts we're going to go out and spend anyway?
This has really been the underpinning a lot of the change in tone that we've been hearing around the U.S. consumer and the U.S. economy, which is the reason why there is such a focus on the Federal Reserve. President Donald Trump finalizing his choice, supposedly, for the next Fed chair. All signs pointing to his chief economic advisor, Kevin Hassett, as a likely candidate to succeed Jerome Powell, which definitely has been fueling the upside in markets. In markets, optimism around AI showing signs of slowing as concerns linger over valuations and spending plans. Global stocks falling in November for the first time in 8 months. Ian Harnett of Absolute Strategy Research writing, America is in a race to dominate AI. We see this as part of a broader objective to boost productivity, keeping the U.S. as one of the world's richest economies. Ian joins us now, and I think that the most controversial question to you is, will it work? Is the U.S. still a bastion of returns and safety?
Well, I think, what we're looking at is an environment where President Trump is determined to win the midterms. They're going to work whatever they can do to avoid recession. I think, our chief rates economist, Abramowicz, wrote a great piece about Kevin Hassett. Looking at his voting profile, that potentially would lead to Fed rates being 75 basis points lower than they might have been otherwise.
This is the reason,
And so, that's one of the things that we're starting from. Definitely recovery rather than recession, I think, Lisa.
This is the reason why a lot of people are expecting an easier monetary policy. The reason why you're seeing that baked into Fed funds futures, as well as the sort of optimistic tone for the forgotten 493. Do you think that that is the right way of looking at this? That either one way or another, the rest of the universe, the equal-weighted universe, is going to outperform?
Yeah, we're certainly expecting that broadening out. We're seeing that in some of the data. But the real question that investors have to answer for 2026 is, this is a really unusual balance. Really strong earnings growth and expectations of rate cuts. That isn't going to survive probably the whole of the year. So is it going to be the growth in the earnings coming down, or is it going to be those rate expectations starting to get raised, even with a more dovish Fed chair, should we say?
Well, you think the AI CapEx endgame is coming, and you think there are signs of a bubble bursting?
Yeah, absolutely. AI is a bubble, and so let's in terms of AI stocks, and that is going to be the problem. But why does it stop? And I think the thing that we see is that the end of bubbles typically comes because cash flows start to get strained. And that can be the cash flows of the producers themselves. And we're starting to see that cash flow headroom coming down. Our quant team have done some great work. But where we're going to see that is that it won't be CapEx that gets cut first. It'll actually be buybacks. So watch out for those. But historically, when bubbles burst, it tends to be that the people buying the goods, the services, they run out of cash. And that's going to be the thing. So, yeah, AI can be a structural story, but are those banks really cyclical rather than structural?
Has it all been exacerbated by the fact that we see a lot of circular financing in this space?
This is a very classic bubble experience. So we're seeing all the classic signs. We're getting exponential share prices. The companies are using those share prices to buy each other. They're buying each other's goods. They're doing it on vendor financing. That circularity that you're talking about. And then this CapEx blowout as the cost of capital comes down for these AI companies. As everybody tries to crowd into that space. That accelerates the build out. But the trouble is the CapEx goes on like that. And if your sales just start to tail off, then the margins get hit. That's when the challenge is going to come for this market, and that's when we get more of a shock.
And this is coming at a moment where ChatGPT is turning 3. This is a reason why a lot of people are wondering, is on its birthday, happy birthday, good luck trying to survive for the next 3 years. There's this question of how much debt's been built out with data centers tied to ChatGPT, to OpenAI, incurring $100 billion of debt in that period. At what point can you see the overall market and U.S. economy continue to grind higher if you do have a busting of the AI bubble in a significant way?
I think at that point you'll be looking for those interest rates to coming down. But historically, when interest rates come down because things go wrong, that's bad news for equities. And that's the point where you could start to see the change. And that's probably going to be later in the year rather than earlier in the year. Actually, the biggest risk that we see for AI is that energy component. America has decided to use fossil fuel, hydrocarbon energy, and that's going to be expensive. Much more expensive than renewables that China is using. And it's also, there's something called the food, water, energy nexus. If you want to have more energy for AI, that's going to cost you something in terms of water, which is going to cost you something in food. Do you want a faster search engine, or do you want to still get your food on your plate? Those are the kind of decisions that we're going to see starting to come to the fore as we see more of these issues raised, I think, Lisa.
I think it's a great question. At this point, I think some people, after spending all the time on the phone, might choose their phones. I am curious, though, from your perspective, going forward, if this is the landscape, do you think that the chance of a negative return on the S&P 500 or the NASDAQ next year and a more negative economic outlook in the United States looks more likely? Because that seems to be what you're describing.
I think when we go into 2027, then it gets much more cloudy. You have to take that decision about higher rates or lower earnings. The big thing that we can see is that short term, these markets are being driven by momentum, they're being driven by liquidity, they're being driven by algorithmic trading. Longer term, what we know is that valuations matter. And so we just published a report recently about the lost decade for investors. If you are really investing for the long run, your long run earning equity returns are probably about 3% over the next decade. That means you're going to get most of your returns from income, not from growth here. And that is going to be the biggest challenge for investors. So recognize this is a trading market, a momentum market, and AI is a big part of that. Investing for the long run, that's a difficult game. Let's go back to 2000. It was the digital age. We're living that digital age today. The big players today are the big players that they were there. Microsoft, Oracle, Apple. All of those companies lost between 65 and 97% of their value, their peak value, and took between 5 and 13 years to regain that value. Digital was the structural story. AI is a structural story, but there's the right price to pay for everything in the equity market.
Can we put two of your thoughts together, that the Trump administration is not going to want to see a recession before the midterm elections, and this idea that you think the AI story is starting to fade?
Yeah.
How does the Trump administration make sure that the AI story does not fade before the midterm elections, given how much of the equity market is propped up by it?
So I think you've got two levers that you can, or a couple of levers that they can operate through. First of all, Secretary Bessent made it very clear that he's very, very keen to keep rates as low as they possibly can. So whether that's the new Fed chair, whether it's using stablecoin to try and inflate demand for bills or redistribute the demand for bills, then that will be one mechanism. What they have to do is to reinflate assets across the economy. The household sector needs to take on leverage. The corporate sector needs to be encouraged to take on leverage. That's the way you get the debt back under control. So what does that mean? They're going to be pumping the housing market. They're going to be trying to unlock. There's $36 trillion of positive equity in housing that can't be accessed at the current time. Assumable mortgages, something like that. Some kind of innovation, privatization of Fannie and Freddie. Those are the kind of things I think we'll see open up. The other thing is crypto. They will continue this willingness to lend against crypto, to keep the economy going, and however they manage that, then we'll see. Almost a slip of the tongue there.
Ian Harnett of Absolute Strategy Research, thank you so much. Really wonderful to hear about what you expect next year. It is crystal ball season, and we've been getting a lot of them. And there's a lot of positivity because one way or another, there will be a fiscal bazooka or there will be a monetary bazooka or potentially even both.
And potentially even more so if we have a Kevin Hassett as Fed chair. What's interesting, though, of course, you have to remember it is a deliberative body. And because many people view him as tethered to this administration and the president, they might be more willing to come out against him because they are concerned that he is just purely politically motivated.
Does it make the other potential members more hawkish? Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. Now, the latest on the investigation into the National Guard shooting in Washington, D.C. Homeland Security Secretary Kristi Noem says authorities believe the 29-year-old suspect was radicalized in this country. He's facing a first-degree murder charge in the death of the 20-year-old West Virginia Guard member Sarah Beckstrom. The data center that supports the CME Group derivatives exchange says it has bolstered its backup cooling capacity after overheating sparked a 10-hour outage on Friday that roiled world markets. Cyrus One owns the facility about 50 miles from Chicago. It says stable and secure operations have been restored, with additional redundancy now added to the cooling systems. A rally in the metals market to start the month. Silver is trading at a record as traders place speculative bets on the precious metal given ongoing supply tightness and rising expectations for a U.S. interest rate cut. And copper touching a record high on the LME on fears the global market is heading for a supply crunch. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, President Trump making his pick.
Well, is picking a new Fed chair? Are you any closer on that right now?
I know who I'm going to pick. Yeah.
Ooh, tell us. Kevin Hassett.
I'm not telling you. We'll be announcing it. Thank you very much, everybody.
So now the question is, when? When are they going to be announcing it? Sonja Marten of DZ Bank joins next. Maybe to answer that question, probably not. This is Bloomberg Surveillance. there was a question, will the S&P 500 manage to eke out a seventh straight gain? It did. On the last day, it was down 0.4%, and it climbed above it for that seventh consecutive gain, going back for the first time since 2021. We're losing some of that steam, down 0.6%, although the underperformance continues to be in the NASDAQ. Right now, you are seeing a bit of euro strength, dollar weakness, a real question about potential data that isn't coming out just yet from the United States. It's supposed to be Jobs Friday. It is not, but we do get ISM manufacturing and services and ADP payrolls, which people are going to be parsing through. And you do see yields just marginally higher, up 3 basis points on the front end to the mid end and back end. 10-year yields 4.04%. Under surveillance this morning, President Trump making his pick.
Well, is picking a new Fed chair, are you any closer on that right now?
I know who I'm going to pick. Yeah.
Ooh, tell us. Kevin Hassett.
I'm not telling you. We'll be announcing it. Thank you very much, everybody.
Here's the latest. We're getting closer to finding out who will replace Fed Chair Jay Powell, maybe. Sources telling us here at Bloomberg that National Economic Council Director Kevin Hassett is the front runner. Joining us now is Sonja Marten of DZ Bank. Sonja, thank you so much for being with us. I'd love your reaction to both the price action in response to Kevin Hassett as a potential Fed chair, as well as just more broadly, this understanding in U.S. markets of Fed rate cuts that seem imminent.
Yes, I mean, we've seen quite a lot of volatility in rate expectations with a view to the Fed. I mean, the market had initially priced in a lot of rate cuts throughout the coming year. Then there was a lot of pricing out. When during the shutdown, I think people got somewhat overly optimistic, I think, on the prospects for the U.S. And now they're back in the game with more rate cuts. And that's partially, I think, because of some of the weaker data we've had, but also speculation mounting that it's going to be Kevin Hassett who will become the next Fed chair. Trump hasn't said when he will announce. Suspicions are or speculation is he'll announce before Christmas. He'll probably use a politically opportune time to do so. But Kevin Hassett is, of course, considered to be very close to Trump and therefore a monetary policy dove. And that is exacerbating rate cut speculation. And that's what is putting some pressure on the dollar right now.
Sonja, I wonder how much you expect that to continue into 2026. The first half of 2025 was marked by this belief that there would be overstimulation, a suppression of yields, a potential loss of Fed independence, and this would lead to a depreciation of the dollar. You saw the gold trade really pick up. Second half, completely different, flipped on its head. Do you expect 2026 to mirror what we've seen so far in 2025?
Well, maybe not as extreme. I think we've sort of gotten used to Trump a bit more, and we're not as surprised maybe at the way that he conducts policy as we were earlier this year. So I think the amplitudes of market move might be a little bit smaller. But generally speaking, I do expect the dollar to have some downside next year. For one, I think the U.S. economy is not as strong as people have recently come to believe. And there is the Fed issue. And for me, I cannot emphasize enough how important it is to me what happens with Lisa Cook. The Supreme Court will make a decision on that early next year. And I think it's really crucial to see what happens there, because if Lisa Cook does get removed from the Fed board for, a potential crime that she may or may not have committed 20 years ago, I think that sets a dangerous precedent. And I think the whole issue of Fed independence is definitely going to come back on the table next year. Yes.
Sonja, the market, though, is not acting like there is an issue of Fed independence. So do you think that actually, whether or not it's Lisa Cook leaving the board or not, do you think that is actually going to be such an issue? Because the market seems to shrug this off and moved right along.
Well, maybe especially because the market is sort of shrugging it off, I think it may be more of an issue. I mean, we know what happens in these situations. People kind of, gloss over these things, but then they can make a major comeback depending on the news flow. And I do think that issue will come back and resurface. I mean, I'm not saying that we are predicting that the Fed independence is going to become seriously endangered, but I think the whole issue will be a source of volatility next year, and therefore will time and again put pressure on the dollar. And I think maybe the market right now is focusing on other things and maybe not paying quite as much attention to this particular issue as it should.
Well, if the Trump administration decides to put Kevin Hassett as the chair of the Federal Reserve, will it embolden other members to be more hawkish?
Yeah, I heard you mention this earlier. It's an interesting take. I think that, the general market view is often that if the Fed is led by a very dovish president, then that's going to result in a generally dovish council, which I think we can all hope that you're right. And that's not going to happen. That in fact, in a way, we have seen this recently. We have seen that Fed members have been I think, quite honest in their views on the US, and there's not been as dovish maybe as generally feared. So I think there is ideally that scenario where Fed members will feel emboldened to distance themselves from Kevin Hassett if he does become chair. But it will be a tricky time. There's a few new people on this board, so it's going to be a bit of a big shuffle, and there'll be a new dynamic.
It's really fun to play the parlor game of the Fed. We'll keep playing it. But Sonja, there's a larger story here, which is more broadly around the world, developed markets are incurring more debt. They're seeing higher yields. There's a real question of how much that can really reverse next year based on just the overall demographic of an aging population and the debt load at play. Do you see a broader depreciation, devaluation of developed market currencies more broadly? And maybe not only with respect to gold outperforming, but potentially emerging market currencies as well, also doing better than they have traditionally just because of a dynamic that seems to be flipped a bit on its head?
Well, we're actually, when you look at the emerging market currencies, we're actually somewhat negative for the next year. A lot of these countries have serious issues to contend with. And obviously there is, the debt levels, as you mentioned, but also economic issues. Some of these countries have been very hard hit by the whole tariff situation. So I think in general, we're not that optimistic. Also, I think because the high level of uncertainty in the market in general that we are going to carry over into 2026, that is also going to be a factor weighing on these currencies. So I don't think there's going to be a huge upside, broadly speaking. There'll be exceptions, of course, but I think broadly speaking, we're looking at more downside for these currencies.
So is this basically a loss of some credibility in fiat currency right now that you're seeing expressed through gold, that you will see continue to be expressed through gold in 2026?
Yes, absolutely. And we're looking at our gold forecast is still quite optimistic. We're looking for gold to continue to rally into next year as demand from central banks, but also from retail investors remains strong in this area of uncertainty. And as you said, that also reflects negatively on the riskier currencies in general. So I think, that's a risk-off situation that's going to linger throughout next year. And to be honest, probably the next few years, given that Donald Trump is going to remain in office for a while longer.
Sonja Marten of DZ Bank, thank you so much. And we are seeing gold getting a lift. Bloomberg Commodity Index in general has been absolutely flying so far this year. It's right now at the highest level going back to January of 2023. You have a lot of commodities. We were talking about copper earlier, seeing its real boom. Gold has certainly been leading, and a real question here about potential algos that are getting involved. But it seems like the physical world is getting its comeuppance and has been getting its comeuppance, frankly, since the pandemic.
And silver as well. We're seeing silver and copper, which actually are more interesting sometimes than gold because they have real life use cases, not just a store of asset the way you see central banks come out and buy gold, especially if they're concerned about maybe U.S. sanctions or secondary sanctions from the United States when it relates to Russia or China. So yeah, commodities on a tear. And when you think about the AI story, as we just had this hour, all that energy use is going to be needed, and commodities are going to be needed from when it comes to the AI data center rollout.
Yeah, and how does this really play into inflation? We will be getting core PCE talking about inflation on Friday. Unfortunately, it will be from September, so I'm not sure how forward-looking it is going to be. Coming up next, we're going to be speaking with Republican Senator Bill Cassidy about cost of living concerns as you do see the prices of commodities pick up. Mark Lehmann of Citizens Commercial Bank on AI concerns. Claudio Irigoyen of Bank of America. And Amanda Lynam of BlackRock. You're watching Bloomberg Surveillance. Good morning.
There's more reasons to be cautious than bullish right now.
The consumer remains the bus driver.
The market's really telling you that December we're not likely to see a cut.
Ultimately, the market's going to tell the Fed what to do.
The odds of that rate cut have increased.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. To start off the month of December, the 12th month of the year, futures lower with traders coming off 7 straight months of gains on the S&P 500. Tech continuing its streak of underperformance this morning after actually having a loss last month for the first time going back to earlier this March. Right now, all eyes still squarely on the consumer as Black Friday morphs into Cyber Monday with early signs suggesting that Americans are still spending despite waning sentiment. And President Trump has made his decision regarding his pick to be the next next Fed chair, and he'll fill us in at some point. Annmarie, hasn't he been talking about this for a while?
He's been talking about this for months. They have been talking about it for months. Remember, I spoke to the Treasury Secretary months ago, and he said we'll have a decision by the fall, an announcement. Now it's potentially we'll have a decision, an announcement before Christmas at the very end of the year. You see the president's face light up, though, every single time he is asked about this. He loves to talk about monetary policy, and he loves to have this Game of Thrones type atmosphere when it comes to picking who is going to be the next Fed chair. Right now, our reporting is that in the pole position is Kevin Hassett, who right now is the president's chief economist. So lots of questions about actually how much of a political puppet this individual might be, or actually can he at some point put some distance between him and the White House?
At the core of the Fed discussion really is the consumer and spending power and cost of living concerns that have permeated every single poll and every single sentiment survey that we have seen heading out there. This week's going to be interesting because we do not get the non-farm payrolls report as we normally would get on Friday. We do, however, get ISM manufacturing later today. We get ISM services on Wednesday. We do, of course, also get some earnings coming out. We get ADP payrolls numbers as well as core PCE data on Friday and income and spending, although that is from September. So a real question here heading out of what this will really reveal. Right now in markets, you are seeing a bit of a dip in the S&P and the NASDAQ as people look ahead to potential disappointments in the AI space, and a real question of what else can ignite some sort of risk-on rally. You are seeing yields marginally higher, yield curve steepening, a question there of how much this is pricing in some sort of easy monetary policy in the short term, 4.04% on the 10-year. And crude up about 1.3% as OPEC Plus pauses potentially some of its output increases. Coming up this hour, we really do want to get right to this. Louisiana Senator Bill Cassidy. His consumers hit a record spend despite economic uncertainty. Mark Lehmann of Citizens Commercial Bank with stocks sliding into the final trading month of the year. And Claudio Irigoyen of Bank of America Securities as President Trump teases his Fed chair pick. We begin this hour with strong start to the unofficial holiday shopping season, even as affordability concerns grow.
Online sales were up almost 10%. In-store sales were up 4%. It was really a blockbuster weekend after Thanksgiving. And so I think that the folks who were saying, wow, maybe people are going to be anxious about, going back and getting presents for the kids and so on, they've been disproven this weekend. And I think the reason is that incomes are up this year.
Shoppers spent billions on Black Friday and could break Cyber Monday records today. Louisiana Senator Bill Cassidy joins us now for more. Senator Cassidy, thank you so much for being here. Can you square this idea of incredible spending and the ongoing American consumer continuing to uphold the underlying economy and this real feeling that cost of living is becoming unsustainable?
Well, there's obviously segments within our society, and there's a group of people who are still managing to do well. There's another group of people who are really hurting. Now, they may have the money to go out and buy their children a gift for Christmas. On the other hand, there is an increasing cost of insurance, whether it's health, property and casualty, or flood insurance, as well as the increasing cost of groceries. They have extra money, but up here, but there's a lot of folks down here who are hurting.
This is the reason why a lot of people are expecting, even though we are seeing profits at companies continue to increase, they're expecting the Fed to cut rates to respond to that K-shaped economy or the mass of people who really aren't feeling the gains. And I'm just wondering how much you're prepared to step in, that you think that it's government's job on the fiscal side to really support that lower tier of consumers that are really feeling the pain.
I would argue that in the tax cut for working families, or the one big beautiful bill, we attempted to do that. We did it both by no tax on overtime, no tax on tips, for seniors eliminating the tax that most would pay on their Social Security, but also putting in some pro-business efforts that would encourage business to reshore, to build out their manufacturing. Lastly, I will say, there's a lot of money taking place on infrastructure right now, and that infrastructure creates jobs. AI cannot swing a hammer. And so AI is not swinging a hammer. Those folks are being employed. I would say that there is a business strategy to help those folks who are in the kind of struggling area of the economy.
Senator, there's one area when it comes to affordability that actually might become a lot more expensive next year if Congress does not act, and that's the enhanced premiums when it comes to the Affordable Care Act. You have a hearing this week regarding this. Do you think we can get to a decision before the deadline?
Yeah, I think we can. I have a plan, but it's one that other Republicans have proposed some form of. And we take that enhanced premium tax credit, and instead of giving it to insurance companies where they take 20% for profit and overhead, we give 100% to the patient in the form of a deposit within a health savings account. This allows her not to buy the more expensive silver plan, but to also get a cheaper plan called the bronze plan. Now, did I say it's cheaper? It's cheaper. And so we're helping her on her affordability. By the way, the money in her health savings account also gives her first dollar coverage for her child's trip to the ER. You know, I practiced for 20 years as a doctor caring for the uninsured and the poorly insured. I learned that if you give power to the patient, you can lower healthcare costs. So we're giving power to the patient, not profit to the insurance company.
Will Democrats come on board with this plan? It doesn't seem like they're interested in this. They want, at minimum, an extension for a year or two of the extended premiums.
So think about it. We would actually be, if you will, in one sense, extending the enhanced premium tax credit. But instead of giving 100% to insurance companies, they take 20% for profit and overhead. We're giving 100% to the patient. So you're getting an extension.
But the pool shrinks, that money. So
no,
those that are on the higher
why would it
end,
shrink? It does not shrink.
Well, for the insurers, are they going to have to pay more? Or are you going to have to say you're on, say, the premium plan? Or is your plan going to be even more expensive because it's not being subsidized by those on the lower end?
No. Again, going back to this, if you got this amount of money, and currently under the current plan, you give 100% to insurance companies and they take 20% for overhead and profit. Instead, you give 100% to patients in terms of deposits within a health savings account. First, you're lowering their deductible, and because you have lowered their deductible, they can take a cheaper bronze plan. Now, normally you don't because your deductible is higher. We just lowered their deductible. They're getting a cheaper bronze plan. By the way, when you give power to the patient, she gets the health care she chooses to have that she knows she needs, as opposed to the health care the insurance company permits her to have. A lot of wins in here for the patient, who would not be for that, whether you're a Republican or a Democrat.
Do you think that this is enough to prevent the government from shutting down again in January when this comes back up?
Absolutely. Why? Because we've actually addressed affordability on the exchanges. I would argue we also begin to address the overall increase in healthcare cost. When you give that woman, and women make all the decisions in healthcare, when you give her the power of the purse and you say, listen, if you go here, you save money. If you go there, you don't. Everybody begins to lower their cost to where they can attract her business.
You know, you said something earlier that I think is really important. You said that businesses have a role in creating jobs and creating a better landscape for the lower quartiles and deciles of the U.S. economy and the U.S. earners. I just wonder what policies you think need to be implemented to do that, because right now it doesn't seem to be working.
Are you talking about in terms of overall business
Overall
development?
business, yes.
Yeah, so I think that the tax policy that we've put in, and frankly with President Trump's tariffs, there's an incentive for people to begin to reshore, certainly nearshore. And so when you reshore, you're going to create jobs. Now, that doesn't happen like that. Think how long you need to put together your financing stack. But that's going to happen. And so as it happens, we'll see that kind of upswing in jobs for construction, for service, all those jobs that are related to that reshoring of manufacturing activity. And that'll cause a general boom. So that is a sustainable strategy to create prosperity for folks.
A lot of people are saying that the reason why companies haven't created more jobs is because they're using artificial intelligence for efficiencies. And you're seeing that in terms of Amazon coming out and saying they're laying people off because of some of the efficiencies they're getting from algorithmic learning. I'm just wondering, from a legislation standpoint, what you think that the government's role is in trying to make sure that people aren't left behind in this transition, given that a lot of these new programs can take on roles previously done by humans.
I'm a technical optimist. If you've got something that's going to increase the productivity of our nation, we'll increase tax revenue not by increasing rates, but by increasing the overall growth of the economy. When you increase that overall growth of the economy and you have more money, we've got like trillions of dollars of backlog in infrastructure. Let's just focus once more there. If you begin to invest that money in infrastructure, AI does not swing a hammer. You're going to create a lot of jobs for folks who right now are struggling to get better jobs. By the way, we're also building out our oil and gas industry, our energy industry. That creates a heck of a lot of jobs. And so everybody looks at the negative, oh, we're going to downside. We need to look at the positive. That will just shift investment to a more productive area of the economy. As we grow at the expense of other nations, or maybe we all grow together, we'll create that employment.
Lisa started out this conversation talking about affordability. Americans are still struggling. You're also looking at trying to address healthcare affordability by actually having this health savings account proposal. The president talked about $2,000 tariff checks. You're on the finance committee. You lead the health committee. Do you think that that is a good way to address affordability right now, putting money directly into consumers' pockets?
So I'd like to see what the president's going to propose. We do know that the debt and deficit eventually takes money out of our pockets. And so we absolutely know that. So the question is it better to pay down our nation's debt? And as you pay down our nation's debt, then it makes it easier to lower interest rates, for the Fed to lower interest rates, which then lowers a mortgage payment, which then maybe lower other forms of credit. As you do that, you make life more affordable that way. The other thing you have to worry about is if you give everybody a $2,000 check, does that bump up inflation, and therefore the Fed is inhibited on lowering their rates? So it can't be taken in kind of isolation. It has to be taken in context of everything we can do to benefit that person sitting at home struggling a little bit.
It sounds like you would be a no then on the $2,000
no,
checks.
It sounds like I'm going to investigate so that I know.
Okay, well, while you investigate, there's also potentially going to be another big Senate, first a hearing and then a vote when it comes to the president's Fed pick. Right now, the front runner is his Council on Economic Advisors chair, Kevin Hassett. Do you think you would say yes to him being the Fed chair?
I've been impressed with Kevin. This is his second time around serving in Trump's administration. I think he's done a good job. Of course, I reserve judgment until we actually begin to look at him as Fed chair. We are having this problem of inflation, which just is a little bit sticky, and yet we want to decrease rates. How are you going to navigate that? But I'm certainly predisposed to support him.
Are you worried about Fed independence?
Fed independence is critical. You just have to have it. But I also think that Kevin would step up and be as aware of the importance of Fed independence as anybody.
Louisiana Senator, thank you so much for being with us. Louisiana Senator Bill Cassidy here in the New York studio. Very much cost of living on the docket, especially given how much health care has dominated the conversation and potentially, Annmarie, could be the reason why the government could shut down yet again.
Right. There's this going to be the debate. It's happening all of December. The senator is going to be leading a hearing on it. What do you do in the sense that you have these enhanced Obamacare credits that are going to be ending? And for Democrats, this is really important for them to have this fight because this is what the entire shutdown, longest shutdown in history, was based around.
Yeah, right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. Goldman Sachs is buying Innovator Capital Management for $2 billion. The deal will combine the bank with an issuer of a relatively new type of ETF known as defined outcome funds that seek to limit downside risk. Stay tuned to Bloomberg TV for an exclusive interview with GSAM's co-head of third-party wealth, Byron Lake. That's at 3 p.m. Eastern. The man suspected of killing United Healthcare CEO Brian Thompson will be back in court today for a pre-trial hearing. Luigi Mangione's attorneys argue key evidence should be tossed because it was obtained illegally. Mangione has pleaded not guilty to 9 state counts and 4 federal charges. Crypto is seeing a sharp risk-off start to December. Bitcoin plunging more than 6% this morning, while Ethereum dropped more than 7%. The deep sell-off puts the entire crypto market on shaky ground, with traders bracing for more moves lower. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, AI keeping markets on edge.
We are expecting earnings to increase double digits, around 11%. The fulcrum of this market has been big tech. You do need tech to deliver.
Mark Lehmann of Citizens Commercial Bank joining us next. This is Bloomberg Surveillance. A softer start to the last month of the year. We are seeing both the S&P and NASDAQ and Russell 2000 all falling across the board, deepening losses as the session grows older. Futures down 0.7% on the S&P. Yields just marginally higher with yield curve steepening. At the 10-year denomination, 4.04%, up about 3 basis points. And crude higher, with OPEC Plus potentially pausing some of their output increases after a vote over the weekend. Under surveillance this morning, AI keeping markets on edge.
We are expecting earnings to increase double digits, around 11%. The fulcrum of this market has been big tech. When we dig into it deeper and recognize that the AI trade is far beyond the hyperscalers, and hyperscalers are in actually pretty good shape, what we think is the earnings risk is limited, but the valuation risk is higher. So In a scenario in which the AI narrative shifts away, then we can see a 10 to 15% correction in the equity market. You do need tech to deliver.
Here's the latest. Equities under pressure following the longest string of monthly gains on the S&P going back to 2021. Still, concerns about the AI narrative are weighing on the indices and have kept the NASDAQ 100 underperforming. Mark Lehmann of Citizens Commercial Bank remaining optimistic, writing, quote, AI investment will be a powerful economic driver and deflationary force for the foreseeable future. We expect a strong start to the new year, and the market should continue to broaden. Mark joins us now. Mark, thank you so much for being with us, and happy post-Thanksgiving. It seems like the divide between San Francisco and New York is one of vibes, where San Francisco feels really good and positive about AI. New York is feeling less so increasingly as the weeks grind on. Can you just explain this division in sentiment when it comes to what we're seeing in Silicon Valley versus on Wall Street?
Well, it's pretty early out here in San Francisco, but I would agree with your sentiment. It's true that the AI story is largely playing out around San Francisco. 40% of the investment dollars are here, and it's part of the resurrection of the economy and resurrection of the city. All you got to do is drive from SFO into the city and see what the billboards say, and every single one of them is AI. You could be a cynic and say, boy, that reminds me a lot of 1999, and you'd be right. But also 1999 portended the next 25 years of innovation and growth of the NASDAQ and growth of technology. And I see a remarkable parallel between the two. It will be bumpy. Market cap's going to move around a lot during those periods, but it is going to be the story of the next decade and beyond.
Which is the reason why people are celebrating ChatGPT's third birthday, which I believe occurred yesterday. Happy birthday, ChatGPT. And it's raised this question of, are we already seeing the dominance of some of the initial first movers really wane, and whether you're seeing the likes of Gemini take over? I mean, how much you already seeing some of these cycles, the winners and the losers, shaking out in a way that could potentially be pretty disruptive, even if AI is the elixir that so many people think it is?
Lisa, that's exactly the right point. And we've seen it in the last month. If you saw what happened with Google and other stocks in the last month, how rapidly the ascent of market cap and some of the losers, if you will, in even small periods of time. And those moves are so substantial and so historic that that's the story going forward. And you're going to have to be really careful. But I think the theme is the same theme going into the internet boom. If you're not exposed, you're really going to miss out. And this is the revolution. I keep calling it the second coming. I've said it on your show. It's going to happen, and it is happening. The real question is, how do you play it as an investor? And also, what is it, the ramifications for society and for our employment and for our economy? And that's the second story. And I think you talked about a little of that with the senator, and you hit a lot of the right points, because it is going to be a massive disruption. And we saw it in the have-nots technologically going into the internet, with education, with job training, with economic. This is going to be the same ramifications. And again, we've seen these micro bursts in stock both ways.
When you look at the ramifications on society, we had Ian Harnett on the last hour as well, talking about he thinks the CapEx endgame is approaching when it comes to AI. But when it comes to society, is it about the inflationary impulse, what that means for energy prices, or actually is it about concern that AI might just take away jobs in the labor market?
I think it's both. I mean, you're seeing the president really focused on the price of oil, right? It's breaking $60 a barrel, et cetera. And then you're seeing some of the home heating bills and some of the home electric bills skyrocket for some parts of the country. If you see it for the job training, if you see it for other parts of employment, it's going to have huge ramifications. I like the senator, am an optimist. And I said it 25 years ago when you had the dawning of spreadsheets and everything. We didn't not need accountants anymore. Jobs changed. Jobs are going to change. And the information economy is obviously going to change a lot of what those jobs are. We talked 5-6 years ago about running out of workers because everybody's going to demographically shift out and we're not seeing enough young workers. So these changes happen so rapidly and the tonal changes are so big. But I do think there's going to be government I wouldn't say intervention, but they have to play a part in what this means for education and what this means for the future and the cost of education. And all these things are so large, but technology doesn't slow down. Healthcare innovation with AI is going to drive cost lower. And the kind of drug discovery we've seen will start to accelerate. You're seeing it with some of the buyouts that you're seeing big biotech happen with big pharma. Those ramifications are happening real time. Healthcare deflation is going to happen as well. AI is deflationary. What it does to the rest of the economy is much more massive than that because, again, technology is the biggest deflator we have.
You are so bullish on AI. Is there anything about what is going on that gives you pause? Circular financing, vendor financing, any of this concern you?
I think, listen, I'm optimistic because of the ramifications for it and what it's going to mean for society. Do I think every part of this is not perfect? Of course I don't. I think there are bubbles being created everywhere. There's investment dollars being thrown at AI because the people who are late are throwing dollars at it. The market obviously is very optimistic about it, just like I was 25 years ago. Did that mean that the market was going to go straight up? Absolutely not. And I can't predict what's going to happen to the market. But I think the technology revolution is here. You have to be invested in it. You have to be consistent. You have to pay a lot of attention. But sitting around worrying about what will go wrong, I think is important, but I think it should not change your investment horizon and should change your investment patterns.
But it might change how you invest. I'm looking right now at a chart that Deutsche Bank put out showing the 300% gain in the Magnificent Seven going back to the launch of ChatGPT 3 years ago. We have seen this incredible outperformance of a select few number of names. We've seen debt start to come into the picture. If this is a deflationary kind of phenomenon, at what point does the debt become, I don't want to say toxic, but a depreciating asset in a very real sense, especially at a time of rapidly shifting technology?
Lisa, it is such the right point. And I think what we see as a bank is where are we putting our own investment dollars, where we're putting our own capital, what kind of companies we want to take public. It's a story that plays out in every sector over time, which is where do you want to spend your dollars? Who are the right technology leaders? Who are the right companies? Who are the right leaders for those companies? And where do you get a little worried? And there large gains in those kind of stocks get a lot of people worried. But we've sat on this program a year ago, 3 years ago, 5 years ago, and looked at that list and said, boy, are these stocks overvalued? In a lot of respects, that would have been a big mistake. But again, look what happened over the last 6-8 weeks. Look at the moves in NVIDIA and Google, and look at the amount of market cap that gets created and destroyed in a very short time. If you're not paying attention, that's a problem. And if you're not invested, that's also a problem.
We're paying attention, Mark. Thank you so much for being with us, and thank you for waking up so early in San Francisco. Mark Lehmann of Citizens Commercial Bank. Always wonderful to get your insights, and I'm sure we will again. It really has been this incredible divide between Silicon Valley that sees the potential and Wall Street that's getting increasingly worried, not about the potential of AI, but about the valuations.
But as Mark said, he's not looking at it as an investor. He's looking at the societal impacts and what AI is going to mean technologically for our future. I loved what he said about he thinks the Trump administration is going to be interventionist. Thinks they already are. Look at Intel, look at MP Materials, Lithium Americas, everything has to do with the supply chain for AI. They want to stake in.
Yeah, how are you interventionist? Is it in the physical world, or is it in some of the job trading or the potential other societal ramifications? Coming up, we're going to be talking about the ramifications for the Federal Reserve with Claudio Irigoyen of Bank of America Securities. He has a revised Fed rate cut call. Plus, you hire on into their morning movers. Moderna shares falling after a legal setback. This is Bloomberg Surveillance. Well, it's a slow start to the last month of the year, but we will maybe get a Santa Claus rally just yet. We did get one heading into the end of November, at least for the S&P 500, leading to the 7th straight monthly gain for the first time going back to 2021. This morning, you're seeing losses continue to mount in pre-session trading, down 0.7% on the S&P futures. NASDAQ underperforming yet again, down 0.9%. And the Russell 2000 doing poorly, down 1%, even though A, we don't get non-farm payrolls, and B, there is is more than a 100% chance of a Fed rate cut this month, now priced into Fed funds futures, which you could see priced into the bond space is it isn't necessarily an all clear. You are seeing yields inflecting higher, pretty much flat on the 2-year, but that yield curve steepening has been mounting throughout the morning. 30-year yields up 4 basis points. And a real question here about how much near-term rate cuts will prevent longer-term rate cuts over the 2026 and 2027 periods. We'll get into that discussion in just a moment. 2 hours away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. We start over in Europe with Airbus. Shares are falling 8.6% in the pre-market on a Reuters report that the playmaker has run into quality issues with fuselage panels on several dozen of its A320 jets. This is coming as the company races to meet ambitious delivery targets by the end of this year. And the sell-off deepened after its A320 jets suffered a software glitch just days ago that affected about 6,000 A320 jets. And though that problem has now mostly been fixed. Meanwhile, moving on to crypto, we are seeing crypto-linked stocks falling this morning. Amid this risk-off tone that we're seeing in markets, just moments ago, I checked Bitcoin was down more than 5%, trading just above $86,000. And most of that has to do with the risk aversion we're seeing in markets, but also China's central bank saying that it plans to clamp down on crypto. And we end on Moderna. Those shares are also falling 4.2% in the pre-market on a major legal blow by a judge who rejected most of its attempt to avoid a patent lawsuit filed by Northwestern University. The company now faces claims that it misused the school's technology in order to develop its blockbuster COVID-19 vaccine. This is coming as the pharmaceutical company continues to struggle amid the decline of its COVID business. Lisa?
Thank you so much, Yahaira. On our radar this morning, President Trump downplaying concerns over escalations with Venezuela, saying people shouldn't read much into a post where he said the country's airspace should be considered closed. U.S. forces continuing to amass in the region. Can you explain what happened over the weekend, Annmarie?
There's a widening campaign, of course, in this administration when it comes to Venezuela, when it comes to the Caribbean. The president of the weekend had this Truth Social telling everyone to avoid the airspace. People felt like there was going to be a strike, something happened imminently in the country. Then the president on Sunday said, don't read too much into that post. So he's moving forward and then taking a step back, which is why everyone is in this precarious position on where the administration stands right now and what they want in terms of, is it regime change when it comes to Venezuela? The president said he did speak to Maduro, but we have no readout or understanding what the two leaders actually discussed.
How much is this an issue of trying to secure U.S. influence in Latin America? How much is this an issue of immigration? How much is this an issue of drugs? How can we understand this in the broader discussion, as we were having earlier this morning, of the U.S. seeking to plant its influence more significantly in Latin America?
Well, this is the conversation we had the last hour when it comes to narco-terrorism, when it comes to immigration to the United States, but also when it comes from influence from the likes of Russia and China in Latin America, and the United States really trying to claw that back into what they would assume is their own sphere of influence. We haven't just seen it in Venezuela. We've seen it in other countries as well, particularly in Argentina.
Yeah, and this raises questions about rare earth minerals and others, which we will continue to parse through. Meanwhile, Airbus facing new quality control issues. Reuters reporting the plane maker discovered problems with fuselage panels on several dozen A320 jets. This after the company was already repairing thousands of aircraft following flight control software issues. And President Trump saying he has decided on his pick to replace Fed Chair Jay Powell, and he's expecting his nominee to cut rates.
Are you Fed Chair, or are you any closer on that right now?
I know who I'm going to pick. Yeah.
Oh, tell us.
Kevin Hassett.
I'm not telling you.
Trump's chief economic advisor, Kevin Hassett, is seen as the front runner. I love the, ooh, tell me, in the background.
And then is it Kevin Hassett? He just smiled, and then he said, okay, that's enough for now, because he didn't want to get drawn into maybe adding more of what he thinks. Whether or not he actually knows who it is or not, he clearly has a front runner's mind and is likely Kevin Hassett, who said, I think the market reaction to the rumors of him was quite positive. So didn't actually endorse that he should be the next Fed chair, but sort of did in a backwards way.
So we'll get drawn in by the Fed discussion. Bank of America Securities revising its Fed call and now expecting another 25 basis point cut at next week's meeting. Claudio Irigoyen of Bank of America Securities joining us now for more. Claudio, wonderful to have you. Thank you so much. What solidified it for you, the idea that next month really was going to be a lock, or this month, I suppose I should say, for the Fed rate cut?
I think
there is a lot of focus on December or not. Now the market priced more than 100% probability of December. But to me, the underlying question is what the market expects the Fed to do versus what the Fed should do. And this is important coming into next year because we're going to have a new chairman, probably with a mandate to cut interest rates. And when you take a look at the economy, financial conditions are not tight. The economy is doing well. We actually revised our forecast for next year to 2.4% growth. And by the way, the call that we have for December comes with another 2 cuts in June and July. So we're still sticking to 3 to 3.25 as a terminal rate, which we already think it's quite accommodative in nature, really. So to me, the question is, okay, if they cut 2, 3, 4 times between now and mid next year, what's going to happen to the economy? What's going to happen to inflation expectations? Because to be honest, there is zero chance that we're going to have inflation, core PCE coming close to the target before the end of next year. In fact, with the exception of China and Europe, most of the central banks in the world will have inflation above their targets. So most of the central banks are coming to the end of the easing cycle.
Why then are we seeing inflation expectations so contained in market probabilities? Maybe not necessarily in the University of Michigan sentiment survey, but certainly in terms of market pricing. Why have we not seen markets sort of clamor to revive their bond vigilante spirits?
I think there are a combination of things, probably some technical issues also playing in the market. Markets focus a lot on long-term inflation expectations. Companies cannot care less about 10-year inflation expectations. They don't make decisions based on that. They focus more on 1-2 years inflation expectations. And those numbers, as you said, as you mentioned, they are not 2%, not nearly close to that. So I think there is still an underlying issue. Let's see what happens with tariffs. Let's see what happens with the Supreme Court ruling on AIPA. That can change things in the short term. But there is an underlying issue with inflation that has nothing to do with tariffs that indicates that inflation will be persistently high and above the target.
So if the Fed cuts in December, which, as you said, it's more than 100% chance, what happens for 2026? How do they continuously cut interest rates if you think inflation is going to be this underlying problem?
Well, it's the debate between what they are going to do and what they should do. Let's not forget that between the December meeting and the January meeting, you're going to have 3 employment numbers, 2 CPI numbers, 2 unemployment rate numbers. You're going to have a lot of information. It wouldn't be a bad idea to say, listen, we remain on hold in December. There is a lot of data that we need to revise. And if conditions are guaranteed, we're going to cut again, because the last 2 cuts were insurance cuts, which means that the Fed didn't have sufficient information to say this is the right thing to do. This is just in case we are wrong. Another insurance cut, 3 insurance cuts, I mean, probably too much.
You think financial conditions aren't tight right now?
They are not.
But aren't they tight for the lower end consumer?
Not necessarily. I mean, with consumption, there is a tricky thing. This is what we call K-shaped consumption. And we have very good credit card data at Bank of America, and you can see that consumption is driven by middle and higher income brackets. Lower income brackets is no more than 15-20% of aggregate consumption, so it's not that important. That's where you're seeing some delinquencies, some issues, but aggregate consumption is fine. There is the linking between the labor market and aggregate consumption, and the question is 6 months from now, are we going to see much weaker consumption or much stronger labor market because companies will revise their hiring plans because much lower uncertainty about tariffs, etc. And probably it's going to be the second, the labor market recovering to continue supporting consumption. So if that is the case, you're going to see 6 months from now a very strong economy that might make you think that these cuts were probably too much. So 3 months from now, not even 6, 3 months from now, it's going to be interesting before the new chairman of the Fed. Probably want to know who's going to be by then, but before the new chairman of the Fed takes over the Fed, where the economy is. Because the first half of the year, you're going to have a significant fiscal impulse. It's an electoral year. Probably Trump will de-escalate on trade tensions and focus more on deregulation. So absent
a spike in inflation that tighten financial conditions or a correction in the stock market because of AI-driven story, the economy will look strong.
The picture that you're painting is really interesting, especially given that you're head of global economics for Bank of America, because this isn't just a U.S. story. This really is a global story with respect to huge debt loads in a lot of developed markets, persistently high inflation above that 2% target, and a feeling that politically people cannot pull the strings and actually cut those deficits. So how much are you looking at maybe a good global growth backdrop next year, but potentially a really bad backdrop for debt going into a potential year where every economy has an incentive to run their society hot?
Yeah, I mean, 2025 was about 5 themes. Trump policies and the associated uncertainty, AI boom, the idea that productivity will boom in the future, China overcapacity, important because China is exporting deflation and goes to the rest of the world, fiscal deficits, and excess global liquidity. So what's going to change into 2026? Probably Trump is going to focus more on the regulation and less on trade escalation, but the rest of the things will be relevant. And excess global liquidity, I think it's key because people focus on the labor market making, the stock market making new high here, but stock markets are making new highs everywhere, in Japan, in China, in Latin America, you name it. And emerging markets are rallying, the spreads are making new tights every day, and gold is also rallying, and private credit is also rallying. So when everything is rallying across all asset classes, across all the regions, has to be something else, has to be a common factor, and I think that common factor is excess global liquidity. So and those imbalances are important because any shock that hits those imbalances and tighten global financial conditions, for instance, higher inflation in the US that forced the Fed to review their policies, can contaminate the global backdrop very quickly.
Do you think the US is still going to be the brightest shirt in a dirty laundry bin or whatever cliche you want to use?
Well, I mean, fiscal problems are not the US problem only, right? You have fiscal problems in Japan, you have fiscal problems in the UK. Actually, there is a convergence between developed and emerging markets for the wrong reasons, right? In the sense that some of the problems in developed are similar to the historical emerging market problems in terms of the dynamics. But if you take a look at growth projections, we expect 1% growth for Europe and 2.5% growth for the US. And less than 1% growth for Japan. So within developed economies, the US story seems to be the brightest story still there.
Claudio Irigoyen, thank you so much for being with us. Claudio Irigoyen, head of global economics for Bank of America Securities. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg brief with Vonnie Quinn. Vonnie.
Lisa, thank you. Indonesia's National Disaster Agency says heavy rain and flooding has killed more than 300 people. Another 279 are listed as missing, while more than 126,000 have been displaced. Authorities are relying on helicopters and light aircraft to deliver aid, with major roads and bridges cut in some districts. U.S. Special Envoy Steve Witkoff heading to Moscow as U.S. and Ukrainian negotiators say they had productive discussions about a framework for a peace deal. The two sides discussed potential parameters for a ceasefire as they pored over a 19-point proposal that emerged in Geneva last week. Disney's Zootopia 2 won the holiday weekend box office. The movie brought in $156 million at the US and Canadian box office over the Thanksgiving weekend. The film achieved the highest global opening for any animated picture in Disney's history, with a haul of $556 million worldwide. And that is your Bloomberg brief. Lisa.
Thank you so much, Vonnie. Up next, credit skepticism.
That skepticism is predicated on concerns about your AI, about private credit, and obviously what's going to happen with the Fed at their December meeting. We actually see going into 2026 a very optimistic scenario playing out.
Amanda Lynam of BlackRock joins us next. This is Bloomberg Surveillance.
A bit of softer tone to start the last month of the year after a 7th straight monthly gain for the S&P 500, down 0.7% now on the S&P futures. You are seeing that decline continue to grind further at session lows right now. Your 10-year yields just up less than 3 basis points as people game out Fed strategy. Under surveillance this morning, credit skepticism.
That skepticism is predicated on concerns about AI, about private credit, and obviously what's going to happen with the Fed at their December meeting. So those three things are kind of weighing on investors' minds, but we actually see going into 2026 a very optimistic scenario playing out.
Here's the latest. Private credit concerns continuing to weigh on investors, even as losses from defaults are staying low. Amanda Lynam of BlackRock writing this: "We believe the peak in defaults in the public credit market is behind us." Amanda joins us now. Amanda, thank you so much for being with us.
Thank you for having me.
This is the big question, right? How much are people pricing to perfection credit at a time when potentially defaults are going to inflect upward? There's been a lot of debt issuance in the tech space, and there's a feeling that private credit has gotten a little bit heady.
Okay, so I think there are a couple things to note. One is we often get asked in the corporate default market or corporate credit market when the peak in defaults is actually going to arrive. And what we point investors to is the data that actually shows in the leveraged loan market, for example, defaults peaked in November of 2024 at 7.7%, which is actually a fairly high number. That's using Moody's data, issuer-weighted trailing 12 months. But the point is that we think the peak in trade policy uncertainty is likely behind us. We think the peak in growth concerns is behind us, and we think the peak in debt service cost headwinds from higher interest rates is behind us. So when you put those three things together, coupled with a good enough growth backdrop in 2026, it's hard for us to envision a new peak in corporate credit defaults. And again, keeping in mind that we've already had kind of this flush in 2024 because of the high borrowing costs. I think coupled with that, our view for corporate credit, both liquid and private, is one of dispersion but not widespread market disruption. And I think that's really the key point to keep in mind.
So a positive outlook, a constructive outlook, as long as you're careful and you don't get some of the bad stuff. A real question, though, about just the spreads are pretty tight.
Yes.
But you have had a pretty loose market.
Right.
And there is a feeling that maybe the appetite is waning for some of the tech-related debt, in a sense that maybe things have gone a little bit too far too fast.
It's a great point. Our view on credit is that if you're owning credit, you should be owning credit for income and yield, not necessarily because there's room for spreads to move materially tighter, and actually not because we think intermediate or long end rates are going lower. So that's really the view. That's a different way of thinking about credit versus past regimes when you had kind of a total return boost from tighter spreads and lower rates. It's really that income component. I would say to your second part of your question, we're not really seeing on the ground that appetite is waning to a large degree in credit. In fact, a lot of these episodes of widening, and by the way, we think episodic volatility is a feature, not a bug of this market, but those periods of episodic widening, they're getting bought. And so high yield spreads are actually back below 275 using your Bloomberg index. So it's really, to us, I think, pretty evident that there is a fair amount of capital on the sidelines. It's income and yield based. There is demand. And I think while spreads are tight, our view is that the bar for a sustained sell-off in credit spreads is also quite high. To get that, you would really need a severe deterioration in the growth backdrop, and we're really not seeing that, which goes back to this point of there's a lot of dispersion. There will be winners and losers. Not every part of the credit market is keeping pace with this tightening, but we don't see an environment of widespread market disruption.
When you look at the uncertainty, though, you named policy like tariffs uncertainty being one of them that you feel like you're past. Does it bother you that we still don't have a decision from the Supreme Court on IEEPA?
I think our view is that if the Supreme Court does strike down the IEEPA tariffs, that the administration has been pretty clear that they have other tools in their toolkit, such as sector-specific tariffs. So our view is basically that tariffs in this regime are likely to remain in place in some form. The key question is, are corporates adapting to that? And actually what we see in the margin perspective is that actually margins are holding in relatively well, and corporates have been forced to find other ways to protect their bottom line, whether that's through operational efficiencies that were originally supposed to take place over a couple of years. Maybe they're front-loaded, changing product mix, eliminating some SKUs. So it's really a bet on the management teams to figure this out, just like during the pandemic. The trend of corporate resilience was actually much more pronounced than I think many market participants feared.
There's a fiscal side of this and the administration side of this, and then there's the monetary side of this. And we've been talking about the expected rate cuts coming this month as well as potentially next year. And you said that you do think that some of the peak rates and peak uncertainty around that has faded. At what point is that sort of a necessary ingredient for your constructive outlook on credit next year?
Sure. So I think our view on the monetary policy path from here is that there's probably 1 or 2 more rate cuts in the pipeline. But as we get closer to neutral, and Chair Powell has said we're probably already at the high end of some estimates of neutral, that will become a more delicate balance between their dual mandate. And so really what we've been emphasizing is the depth and the drivers of this rate cutting cycle are far more important than the timing of this. And if the drivers of the rate cutting cycle are driven by a significant deterioration in the labor market, that's not a great outcome for credit. By contrast, if the drivers of the rate cutting cycle are ongoing improvement in inflation, then that's a more benign outcome for credit. That said, it's hard for us to see rates going below neutral. We're expecting a normalization of monetary policy, not a sharp easing. So I think that income play on credit remains intact to a certain degree. It's moderated, of course, from the peak as rates have come down. But again, that's a double-edged sword. The yield backdrop for investors has moderated, but so too there's been some relief in debt servicing costs for corporate borrowers, which is important.
You were talking about being selective, and I do wonder, happy birthday, ChatGPT, third birthday. We should just touch on how much debt has been issued from the tech giants. We have seen $100 billion of debt tied to OpenAI and data centers that do provide services to them over the past number of months. I just wonder, does that make you nervous? Does that make you want to stay away from that debt as a potential pothole in an otherwise pretty bright backdrop?
So I think we view this as a bit of a regime shift in terms of the leadership of issuance at the sector level. As you noted, technology issuance actually months ago outpaced all other full years on record in the U.S. IG market. So it's been kind of a real paradigm shift in the way that the market is absorbing tech issuance. We think there's a lot more room for this to play out. Actually, if you just look at a very modest estimate of increasing gross leverage by half a turn for the Mag 7 ex Tesla, so excluding autos, there's hundreds of billions of debt capacity that could be added. So that's a large amount of debt, actually upwards of $400 billion. And again, a modest tweak in leverage. We don't expect all of that to be used immediately. We think more likely it will be gradual over time. But I think the market is adapting to a realization that tech will be a larger contributor to issuance. But again, the demand for this has been very robust. And I think just like in sectors like biotech, where there are drug discoveries that happen years after bonds mature, it's almost a similar bet on the management teams.
So you'd be patient. You'd be buying.
I think from our perspective, we think that this is actually a regime shift that has been met with a significant amount of investor demand.
Amanda, awesome to see you. Thank you so much for being here. Amanda Lynam of BlackRock here with us in New York. We are talking about the debt backdrop because that has been what's gotten people nervous over the past couple of weeks and months. This idea that this is a new segment of this story, which is it is including a little bit more leverage.
Right. And to Amanda's point, though, the appetite has been insatiable. And you mentioned it, $100 billion these tech companies are tapping the debt markets for. And people are just buying it up consistently. The appetite has been robust and healthy. At the same time, a lot of people are saying, where are we actually going to see the shovels in the ground, the data centers being built? Remains to be seen. Maybe 2026 story.
Well, 2026 will be a story of a question around the debt, but also a question around the evolution of AI. Coming up, we'll talk about that with Seema Shah of Principal Asset Management, Leo Feler of Numerator, Abigail Watt of UBS, and Oksana Aronov of JP Morgan Asset Management. You're watching Bloomberg Surveillance. Good morning.
The fulcrum of this market has been big tech.
We are still in the early stage of this AI investment or AI arms race.
We actually see going into 2026 a very optimistic scenario playing out.
The air is coming out of the bubble rather than the bubble bursting.
To call this a bubble, it's wrong.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Questions swirling about the resilience of big tech on ChatGPT's third birthday, with the forgotten 493 continuing a streak of outperformance. All eyes on who President Trump has picked to be the next Fed chair, with growing bets of a December rate cut bolstering last month's risk-on flavor, and a focus on the little bits of data we get this week to determine whether the economy is speeding up or slowing down. It was supposed to be non-farm payrolls on Friday. It is not. It is now ISM Manufacturing Monday. Annmarie.
It doesn't feel like the first week of a new month. And by the way, the last month of the year, where has this year gone? Without the jobs report on Friday. But if we were going to get it, all this data we're getting, at least a lot of it, is going to be really stale, like the PCE on Friday. So I'm looking at actually what happened in terms of real money being spent when it comes to Black Friday. Potentially we'll get a readout end of evening when it comes to Cyber Monday. And even though you made a really good point about hasn't been adjusted for inflation, the consumer is still holding up. We're talking about billions and billions of dollars the American consumers decided to go out or online and spend on Friday, and that's continuing into the weekend, potentially into this week as well.
This is the reason why people are kind of at a crossroads. You're seeing a more than 100% chance of a Fed rate cut being priced into Fed funds futures right now for the meeting that happens next week from the Federal Reserve. You have this idea that going forward, they will have space to continue cutting rates going forward. At the same time that you've got a resilient consumer, and you have Claudio Irigoyen of Bank of America saying he thinks that inflation is going to remain persistently higher and really test the hands of a lot of central bankers. It kind of raises this question: how data dependent is this Federal Reserve within the absence of data and at a time of changing personnel?
Right, but the current Fed chair, Jay Powell, has made it clear you can pretty much look through the inflation prints because we're not going to see the potential pass on from tariffs all at once. You can look through all the hot inflation prints at the same time. They have been concerned with what's going on in the labor market. All of this is happening while we get a changing of the guard. And the president said yesterday on Air Force One, flying back to Washington, D.C., that in his mind, he knows who he's going to pick. And it comes on the heels of our colleagues reporting at Bloomberg that in the prime position is his chief economist, Kevin Hassett.
So will he cut rates? Will it be Kevin Hassett? Will ISM Manufacturing show something? Here's what we've got coming up for the day ahead. At 10 a.m. Eastern, we do get that ISM Manufacturing. Watch out for new orders, employment, and prices paid. The components are all going to have a greater degree of importance. President Trump will be signing bills. Jerome Powell will be speaking tonight at 8 p.m. Eastern at an event in Stanford. It is, of course, the quiet period for the Federal Reserve, but it is a memorial event, and we're going to be watching it as well. And then, of course, we do have Steve Witkoff heading to Russia, the whole question, the backdrop of Russia-U.S.-Ukraine discussions. Right now, we are seeing bonds and stocks continuing just to sell off a touch to start the new month, down 0.7% in S&P futures, yields higher by about 2 basis points on the 10-year. Coming up this hour, Seema Shah of Principal Asset Management with stocks edging lower. Leo Feler of Numerator providing a consumer check-in as the holiday shopping season rolls on, and Abigail Watt of UBS previewing a crucial week, potentially, of economic data light. We begin this hour with stocks sliding to the kickoff, the final trading month of 2025. Seema Shah of Principal Asset Management writing, AI will remain the dominant force in the year ahead, although mounting concerns over a potential bubble may limit its ability to propel equity markets and household wealth. Seema joins us now. Seema, thank you so much for being here. Great to see you.
Great to be here.
So start with this conundrum. On one hand, you can believe that AI is a transformative technology that will have a huge impact on the world as we know it, but there still are questions about valuations. How are you sort of parsing that conundrum, or as you call it, paradox in 2026?
Yeah, I think what we're seeing, at least this has really taken off over the last 2 or 3 months, is that narrative has shifted. So there's still optimism about what AI can potentially deliver in the long term, but there are concerns that we don't really know. And how can we continue to invest in such a huge amount in something that we don't know exactly when it's going to start to deliver their return on interest on investment? So we think it's still going to drive markets. We think it's still going to be really key. But in terms of how much it really propels equity markets, how important it is for household wealth, that starts to diminish. Now, that doesn't need to be a really negative story, but it does mean that we need to start thinking about where else we're going to be getting this growth from.
Yeah, especially given the fact that a big question is the state of the consumer and the state of the rest of the economy. A lot of people have been coming on the show looking into their crystal ball, saying 2026 is going to be the year of the rest of the 493, that's going to be the adoption. That's going to be a real question of a broadening out in a trade in equities. Do you agree with that?
I think there is definitely room for the other 493 to do fairly well. I mean, we've seen signs of that already this year. And when we're looking forward to 2026, we have a fairly constructive macro outlook. It's not accelerating growth, it's not incredibly strong growth, but it's fairly mundane, benign. And in that kind of backdrop, you can see other sectors performing fairly well. We still like financials. We think consumer discretionary can actually do pretty well in the first quarter of the year. So there are areas, but I do think at the same time, it is very difficult to completely separate AI from any of the narratives out there. particularly within the macro space. I mean, when we talk to clients and we talk about inflation, unemployment rates, growth, wherever you talk now, AI is a really key component of it all.
Going into the end of the year, what are clients most nervous about?
They're still very worried about the AI bubble. I mean, that's their key concern. They want to make sure...
Even more than the Fed?
Even more than the Fed, actually. And it's been an interesting shift in the last couple of weeks where there was real concern about what the Fed was going to do. Now there's the almost full pricing of a rate cut in December. And this belief that the Fed will continue to deliver as necessary. So this feeling that policymakers are still going to be there to prop up the economy, prop up the market if necessary. And I think that's a real reassurance.
You talked about the forces that define 2025. Inflationary pressures, the policy uncertainty out of Washington. Some of that has been quite acute. And you said it's going to shape the contours of 2026. When you look at policy, what exactly do you think is going to shape from 2025 into 2026?
So I think, these are real anchors for the economy. They always have been. This year, everything has been a little bit more heightened with the change in administration, the tariffs, etc. Now, for 2026, we think that tariffs is still a story. It's just that companies know a little bit more about the way that the administration is behaving. I think companies have decided are able to adapt. So that's key. Inflation is also still there, lingering in the background, still worries about how companies are going to pass it on to consumers, what happens to their margins. But it's less of a concern. So a lot of these things are still there. They're shaping the contours. But we have found that companies and consumers are able to think beyond that, so that increasingly there are other narratives that we need to be thinking of.
So you have a very global investor base that you talk to, a very global client base. And I would love to understand if the story of AI optimism with the backdrop potentially of worries evaluation, is that a U.S. story or is that an international story that kind of weighs the same way in, say, Asia and, say, Europe?
So it's a theme that all investors, wherever we're talking to, are still thinking about, but thinking about it in slightly different ways. So if you're in Europe, the fact that there are concerns about AI valuations does mean that Europe is a little bit more attractive. Nobody's expecting it to be a complete outperformer, but its stability and the fact that it has less exposure to technology within the main indices is a key winning point. So that is a kind of a focus of, we want to diversify. Europe may be a point of stability. And within Asia, a lot of people, of course, believe in the AI narrative still, but they're looking at the valuations which are a little bit more attractive than what you're getting in the US. So actually for 2026, people believe in AI still. There are concerns, but what it means is that they are trying to shift their global exposure to focusing a little bit more on Europe, focusing a little bit more in Asia. You still have some exposure to the US, of course, but it's more of a global diversification story than I think it was at the beginning of 2025.
How much does this play out both in bond markets and currencies? Because people have been looking for an excuse, or they were at least earlier this year, to diversify away from the United States. How much are they going to take this opportunity to do so on a non-currency hedged basis, meaning that there will be that sort of dollar depreciation that a lot of people were expecting to continue into the second half of this year?
It's funny, that doesn't seem to come up that much in conversations at the moment. I mean, when we're talking about the dollar as well, the growing belief is that, look, the dollar has essentially stabilized from here. We're not going to expect to see very significant movements. So that is a slightly different, tone to the talks that we were having about 6 months ago. So the focus, again, on Europe, on Asia, on parts of emerging markets, still very, very key without necessarily having to worry about the currency aspect.
We were talking to Claudio Irigoyen of Bank of America. It really stuck with me, this idea that you could see inflation pick up around the world and accommodative policies from developed markets around the world, because there isn't the political will to push back against this, which means that inflation is going to remain high. And it just sounds like a really bad backdrop for bonds. I mean, at this point, why not just invest in real assets, in stocks, and avoid the bond market altogether, particularly from the developed market, unless you're really just looking to lock in and sort of immunize any kind of schedule of payments that you have?
Yeah, I think we are expecting inflation to be somewhat elevated, right? So still above central bank targets, but it's not very volatile. We're not expecting inflation to be creeping higher, or at least to moving significantly higher over the coming months. So that's still a constructive backdrop for bonds. Having said that, though, we do think that there are other opportunities beyond the bond space. You mentioned private markets, real estate, infrastructure. Those are all really interesting stories in this backdrop where you have persistent inflation, but it doesn't necessarily detract very, very significantly from bonds.
What else do you like? Are you still interested in gold? It was a story of 2025. Think it persists in 2026?
I think that gold has had a lot of its heyday. That doesn't mean that it's going to come dropping back down again. But so much of the reason that people were excited about gold this year was about political instability. And I think going into 2026, that concern is fading a little bit. In terms of, from a long-term structural perspective, worries about what happens over the long term credibility of your institutions. I don't think that's disappearing entirely, but having faded a little bit from the general narrative, it means that the shine on gold is fading a little bit. And so we start to think about whether other opportunities are.
You're visiting us from London. I'd love to get your perspective on what's going on in Europe right now, because they seem to be caught in the middle between what is going on with China and the United States.
Yeah, they are. And I think, whereas once it was a lot about which part of the world we're going to lean into, I think increasingly the biggest concern is that as China navigates this tariff environment with the US, they try to double down on where can they export to. Europe is really sitting in the crosshairs of that. So, in the last few years, we've seen all these concerns from the US saying that China's industrial policy has really hurt the US. It could be that the narrative starts to shift where for Europe, it does become a real concern. And so for Europe, it becomes increasingly important that governments really do invest in the infrastructure. What are the other industries that can really do well to take over the baton from the manufacturing sector? So I think that is key, especially from the deflationary side. What is the ECB and how they're going to be responding to some of these risks?
Seema Shah, thank you so much for being with us, and great to see you in person. Seema Shah of Principal Asset Management. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. President Donald Trump is downplaying his social media post that called on airlines to consider Venezuelan airspace closed. U.S. forces have been massing in the region as Trump weighs military action that would go beyond strikes on suspected drug boats. Venezuela's government called Trump's remarks hostile and demanded unrestricted respect for its airspace. Eli Lilly is once again cutting the prices of introductory doses for its popular weight loss drug, Zepbound. Starting today, the lowest dose vial for cash-paying customers drops to $299 a month. It's the latest move in a price war with Novo Nordisk, which is making it significantly less expensive for people to start on the medicines. In sports, the Buffalo Bills dominated the Pittsburgh Steelers 26-7, while the Seattle Seahawks pitched a shutout, blanking the Vikings 26-0. Elsewhere, the Texans held on, beating the Colts as the Jaguars took down the Titans to jump into first place of the AFC South. Finally, the Denver Broncos narrowly escaped in overtime against the Commanders, winning a Sunday night thriller 27-26. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. I never thought I would see Annmarie get excited about
Everyone
football.
knows. I'm not
You
a
actually said, you're like, don't ask me to talk about this.
No, usually. But my dad was so excited yesterday, and so was Mohamed El-Arian, because the Jets finally won. They never win, and they won yesterday, 27-24 against the Atlanta Falcons. And it wasn't in our brief.
Okay, well, you just did
I
it,
bet
so thank you.
I bet that's a Giants fan.
Oh, yeah,
that wrote
writing that brief is a conspiracy theory. We'll dig into that. Up next, the morning calls, plus Leo Feler of Numerator with a consumer check-in as the holiday shopping season rolls on. That's coming up next. This is Bloomberg Surveillance.
Is it better to pay down our nation's debt? And as you pay down our nation's debt, then it makes it easier to lower interest rates, for the Fed to lower interest rates, which then lowers a mortgage payment, which then maybe lower other forms of credit. As you do that, you make life more affordable that way. The other thing you have to worry about is if you give everybody a $2,000 check, does that bump up inflation, and therefore the Fed is inhibited on lowering their rates?
That was Louisiana Senator Bill Cassidy taking on the issue of affordability, which has so dominated Washington, D.C., very much front and focus as we get a smattering of data, not the official stuff this week in terms of non-farm payrolls, but still we do get ISM manufacturing later today, ISM services on Wednesday, and of course jobless claims on Thursday. Right now we are seeing those declines, but the outperformance has been from the equal weight. The S&P futures down less than everything else, which is really interesting given the continued underperformance of big tech, down 0.7% in the S&P futures. NASDAQ futures down almost a full percentage point, building on losses from last month, even though we did see some potential optimism springing, at least from the guests that we have here. Also, the Russell 2000 down 1%. Time now for the morning calls. First up, Bernstein cutting Zscaler to market perform with a $264 price target, saying recent results have, quote, added narrative issues, feeding into worries about increased competition. Those shares down 0.8%. Next up, Stifel cutting its price target in Home Depot to $350, citing third quarter results that point to a weaker underlying category, not captured by expectations, down about 0.5%. And finally, JP Morgan raising its price target in Ulta Beauty to $606. The firm believing Ulta optimized promotions during the third quarter. It expects upward estimate revisions after its earnings print. Do they really have good promotions, Annmarie? Do you shop at Ulta or you don't shop at Ulta?
No, I do. I do shop at Ulta. Yeah, why not?
Right.
I do a mix of Sephora and Ulta Beauty, but Ulta Beauty has been on an absolute tear with the younger generation that does all these skincare regimes for their social media, and you have to go out and replenish. So I might go check out Ulta Beauty today for Cyber Monday.
There you go. All right, there's your pitch.
The emails are coming in hot.
Yeah, well, now they're not going to stop after that. Sticking with retail, U.S. shoppers demonstrating their resilience, including Annmarie, to kick off the holiday season as Black Friday sales increased over 4%. Leo Feler is the chief economist at Numerator, which tracks consumer and economic data. He writes, "We keep seeing retail spending increasing, even for lower income consumers. So consumers saying they'll cut back doesn't necessarily mean they'll cut back. Watch what they do, not what they say." Leo joins us now. Leo, can you start there and talk about what you're seeing so far in this shopping season?
Yeah, thanks so much for having me. So it's definitely the case that consumers say that they are very pessimistic about current economic conditions. And yet this entire year, we've really seen consumers from lower end to higher income consumers increasing the amount that they are spending. And this just suggests that consumers are being very resilient. Although we are seeing them being very selective. And so they're saying they're going to try to take advantage more of promotions, more of Black Friday sales. And this might mean that we saw some of this increase that you saw right now in Black Friday sales is consumers pulling forward some of their holiday spending to take advantage of sales and promotions.
Leo, Lisa mentioned it earlier on the program. It's a record amount of spending, $11.8 billion online on Friday alone, 9.1% jump from last year, according to Adobe Analytics. But when you start to include inflation in that number, is it basically flat where we were in 2024?
Yeah, that's the right way to think about it. I mean, even in inflation-adjusted terms, the amount that people are buying has gone up, but the spend has gone up a lot more simply because we're seeing higher consumer prices. So with some work that I did at colleagues at the Federal Reserve, we saw that for products coming in from China, they are about 10% more expensive now than they were a year ago. So things like apparel, toys, home goods are all going to be more expensive this year than last year. And that means that consumers are, spending more, but not necessarily getting that much more.
When you see the consumer go out and spend in this K-shaped economy, where's the higher end spending and where's the lower end spending?
This is a great question. So we've seen kind of this bifurcation where club stores like Costco are doing extremely well with higher income consumers. And then you have your TJ Maxx's, your dollar stores, your Aldi's doing a lot better with lower income consumers. And so people really are trying to find better value, but that might mean buying in larger quantities, buying in bulk at a Costco, or just getting lower prices, more private label items at stores like Aldi.
What's your sense, Leo, of whether people are being more choiceful? I know that John, who is off this month, has talked about his dislike of that word, but this idea that people are being more deliberate about going out and shopping during times of promotion and looking for those deals. And that indicates really some discretion on the part of consumers, not necessarily, no holds barred, this idea of going out and spend the bank.
Oh, absolutely. This is very different than 2022 when consumers were flush with cash. Coming out of the pandemic, they had, record levels of savings. They were spending down that savings. We had gotten stimulus checks. That was a consumer that was not being choiceful, right? People were upgrading towards brand name items, willing to splurge. This time around, we really are seeing consumers being more selective, both in terms of the retailers where they are shopping, in terms of taking advantage of sales and promotions. And this is why when we look at Black Friday sales, we have to be careful about what signal that gives about how the economy is doing overall, because if people are purposely trying to take advantage of sales and promotions, that might mean that they're going to be spending less at other parts of this holiday season. and overall not really increasing their spending all that much, right? This is the kind of selectivity that we have to be watchful for, because consumers that are watching a buck are the ones that are going to be trying to make sure that they're taking the best advantage possible of all these, Black Friday, Cyber Monday type sales.
Which really goes to the conundrum right now, not only for the Federal Reserve, but for markets. And you said this at the beginning, or the comments that you said, that, essentially watch what they do, not what they say. They're saying they feel bad, but they keep spending. Is it possible for both to be true, for people to feel bad and for them to be cutting back, but continuing to spend anyway, at least in overall numbers? What's the read-through for the Federal Reserve, for the forward look of the economy?
Well, overall, this suggests that the economy is still doing okay. The labor market at 4.4% unemployment, that's a historically, not a bad level. And so, the Federal Reserve is in this conundrum where the labor market is weakening, but it's still doing okay. Inflation has been stuck at around 3%. And we're actually seeing inflation ticking up in core consumer goods. These are products that are normally deflationary or disinflationary. And so this just means that the Fed is really stuck in its difficult position where they are trying to perhaps stimulate the labor market a little bit more, but in a situation where inflation remains high. So I expect a lot of dissent at this upcoming Federal Reserve meeting, given this very difficult situation they're in.
The market has the Fed cutting interest rates. They are more than 100%. They believe that they're going to cut, and you think there's going to be dissents. Do you think that maybe this next week's meeting is a pause from the Federal Reserve?
I think there was so much Fed speak coming into this Federal Reserve meeting where roughly half the members on the FOMC were saying, look, maybe we just wait for more data. We haven't gotten a lot of good data given the government shutdown to be able to make a firm decision at this point in time. And at the same time, we do have this labor market weakness. I really do think this should be a mixed decision right now. And they might err on the side of cutting. But, we have another meeting coming up in January, so it wouldn't be, that inconceivable that they might just skip a cut this meeting, wait for more data, and then make a decision in January about how to proceed.
Leo Feler of Numerator, thank you so much. Maybe the good news is that we don't have any more Fed speak, at least not official Fed speak, although Jay Powell is speaking later today at an event, memorial event over in Stanford.
You brought up a good point, though, and we talked about this before the show. There will be Q&A. Likely someone is going to ask a question about the meeting next week. And yes, they are in a blackout period, but maybe there's a wink, wink, nod, nod, a sway.
Oh yeah, body language. We're going to be analyzing the body language in the absence
of other
Fed speak. Yeah, we're going to be looking at actually the data that does come out, albeit not maybe the gold standard. Still, some information coming out from the consumer. Coming up, we'll parse through that with Abigail Watt of UBS. Looking ahead to some of those trickles from what the consumer is feeling and doing. Plus, Yahira Anand with your morning movers. Mag 7 futures lower to kick off the final trading month of 2025, led lower by the Magnificent Seven. From New York, this is Bloomberg Surveillance. We are starting the beginning of the last month of the year with a little bit of a softer tone pretty much across the board, a feeling that maybe this can't last, although there are people hoping for that Santa Claus rally. Down about 0.7 on S&P, looking at 10-year yields that actually are up almost 4 basis points now, 4.05%. What you are seeing on the euro is a bit of strength, dollar weakness, 116, the euro climbing by about 0.4%, and crude higher. Watch this space given the fact that OPEC Plus is putting a pause on some of the output increases that they had been engaging with to end the year. 1 hour away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. It is the tech sector dragging us lower with the Mag 7 all in the red this morning as investors continue to question the investments surrounding AI and whether they will get a return. It's a concern that Deutsche Bank flagged in a note this morning remains prominent, with the Mag 7 losing ground in November for the first time since March. NVIDIA, I will also note, just announced it invested $2 billion in Synopsys stock. This is a company part of the chip supply chain, so just raising questions over the circular nature of these investments. Meanwhile, we are seeing Barrick Mining shares rising 3.8% on news that it is exploring an IPO of its North American gold assets. A lot has been happening with this company because amid record-breaking gold prices, it was not able to capitalize due to cost overruns and operational issues. So Elliott Management stepped in back in November, and it has a new CEO also shaking things up. And we end on Airbus, shares still in the red, though paring its losses down 5.3% over in Europe after it confirmed an earlier report that it found a quality issue on some fuselage panels on its A320 jets. This just compounds issues over its most popular aircraft, since just days ago it flagged a software glitch on about 6,000 of those jets. And this is all coming as Airbus rushes to meet ambitious targets for this year. Lisa.
Thank you so much, Yahaira. Turning to the economy, we're not getting non-farm payrolls Friday. We would be getting a whole slew of data that we're not getting because of the backlog from the government shutdown. We are, however, getting ISM manufacturing, ISM services, ADP employment, and, of course, that core PCE data from September on Friday. Bloomberg's Ed Curran joins us now. And what are we looking for, and why is this week particularly important, even though we don't get that sort of gold standard non-farm payrolls report?
As you say, mostly second-tier data. But, Lisa, today we do get ISM manufacturing numbers at least. It's expected to tip upwards to around 49, which is a slight improvement. But if that's the case, it's still in contractionary territory and will mean that it's a ninth month of contractionary territory for that reading on the manufacturing sector. We know there's been a lot of pressure there from the uncertainty around tariffs and on trade policy, but also there will be a lot of focus on what those numbers today tell us about labour demand and broader demand for the manufacturing sector. So several clues that may come out of that. I think the bigger piece for this week, though, as you say, will be the core PCE reading on Friday. This is the Fed's preferred gauge of inflation. It's expected to tick up 0.2% on month, which would mean it's around 3% for the year. That would suggest that inflation is at least stable, even though, of course, it remains sticky and above the Fed's inflation target. But if you get a higher reading than that, of course, it might complicate further the already complicated Fed debate for next week. It's quite dated data. Of course, it's from September, but it's good as we have for it's all we have for now, I should say.
Well, that's what I was going to say, and does it matter at all? Because ultimately it's so dated, and there's a real question around the integrity, the relevance, given the fact that we're in December right now, that will it really factor in at all to the potential Fed rate cut next week?
All very valid questions. They are so dated, these numbers at this stage, Lisa. We know the economy continues to evolve in real time, but it is literally all we have, because we're not going to get either any more jobs or employment data from the BLS before the Fed meeting, or, of course, the CPI data before the Fed meeting next week. So I think we're probably at a space now with the Fed officials whereby they've probably made up their mind on where they're at. You either are more worried about the labour market and what's happening there and what potentially might be happening in the months ahead, or you remain more worried about inflation. It's hard to think those views will change dramatically over the coming week. It's clearly going to be a close decision by the Fed. All we can go on were those most recent comments before blackout, which were leaning towards something of a dovish outcome, but by all accounts, it's clearly going to be a very live meeting.
And Curran, thank you so much for being with us. Right now, there is a 99% chance of a Fed rate cut next week. It has gone down from 102% earlier this morning based on Fed funds futures, but up from some 25% based on just a couple of weeks ago. So clearly, very much the base case.
And Enda is talking about the fact that, though, it's going to be a live meeting. And Leo was talking about earlier in the hour that there's going to be those individuals that dissent at this meeting. So maybe the market is getting ahead of its skis on what we think the Federal Reserve is going to do.
Well, let's get the view from UBS. Abigail Watt of UBS writing this. We still expect a cut in December. We expect there is very vocal disagreement to the point that we were just making, but we also expect a large majority of the committee will support the decision. Abigail joins us now. Abigail, I love that we've gone from a data-dependent Fed to a data non-existent Fed, the idea that we don't even have the inputs. What are you watching to really gauge the vocal disagreement and the outcome of next week's meeting?
Yeah, so look, I mean, it's totally fair to say we don't have the official statistics from the BLS. We should have got that non-farm payrolls report this Friday. We won't be getting that. And the data that we think, would be important for that decision will actually be released week after, right? December 16th, we should get the October-November data from the BLS. Now, we do have other data, though. The committee can see that you've seen initial claims running around a similar rate to before the kind of government shutdown. You can see that when we look across a range of other indicators, you're seeing a labour market that doesn't necessarily look like it's significantly improved since they had those kind of official numbers. And I think for the committee, there is a case of risk management here. If you don't have those official statistics, it feels like the risk is skewed towards removing that excess restrictiveness now in the case of the likelihood that you potentially do see weaker numbers the week after, right? So I think that's the decision in front of the committee as they go into the meeting.
Abigail, then it basically begs the question, how much harder is 2026 if they do end up cutting next week?
So I think 2026 will continue to see this tension for the FOMC. I think you're going to continue to see this issue of inflation pushing away from their target, but simultaneously a relatively soft labour market. And I think that ultimately means that you see the FOMC potentially leaning on that kind of risk management. How do we remove excess restrictiveness? So, I mean, in our expectations, we think they will cut at the meeting next week. And our sense is that they could cut again in January. But then I think that tension potentially becomes a little bit more challenging for them. Our sense would be that you could see a little bit of an improvement in the labour market as you go into the second quarter of next year. And alongside that, we think you should be seeing more tariff-related price pass-through. And that combination, we think, leaves them on hold for a little while through 2026.
Even with a chair Harnett at the helm?
I think it's an important point to note. Obviously, there's potential for personnel change next year, a new Fed chair. Our sense is that you could see potentially another cut in September. If I think about our kind of meeting by meeting profile, we think that by that September meeting, you'll have a new Fed chair in, a bit of a shift in the committee. And alongside that, we think that you potentially see them removing a little bit more restrictiveness from that policy rate. But ultimately, we think that they get down to 3.25 by the end of 2026. We're not necessarily expecting that they deliver a significant easing in policy at this junction. But I do think that, some of the kind of changes in personnel and the sense that you'll be getting past the peak inflation impulse from tariffs, I think that potentially leads to leaning towards a kind of lower federal funds rate in terms of the distribution.
Let's say I'm not getting any of the gold standard data. And I'm saying, you know what, I'm going to look for my own. Not only are we going to get ADP, which I know we've got very excited about, and ISM manufacturing and services, but I can go to the shopping mall parking lots and see how many people are there. I can see the numbers from Adobe that came out in a positive way versus last year in terms of the total increase and say, actually, the consumer's doing pretty well. How valid is it to sort of look at anecdotes based on the corporate world and spending habits during peak promotional seasons and sort of extrapolate out a trend about the overall U.S. economy?
Yeah, so I think you're right to think about the period you're in and whether that's, I guess, a typical period for kind of the level of spending that you would see in the economy, right? I think we are in a period where you tend to see kind of that seasonal shopping coming out and you potentially see support from discounting, right? So I think when we think about the kind of consumer and the look forward from the patterns we see around holiday spending season, I think it does tell us something about the willingness of consumers to spend, but it doesn't necessarily mean that we would expect that is a trend that can be persist and kind of pull forward. I think, when we think about the end of the year and into early next year, when we get past this holiday spending season, our sense would be that you see more of a kind of inflation hit for consumers. And I think when you start to see that, we could see a little bit more retrenchment, we think, from the consumer through this period.
I just think about how every time I go upstate and I see the car lots being full in terms of car dealerships, I think, uh-oh, bad economy, bad economic season. Or if I see fewer of them, I think, wow, okay, they're flying off the shelves. Annmarie was talking about how she puts in her shopping cart a number of things, doesn't buy them, and then she gets the promotional email saying, why not continue to shop for these items? I wonder if things like that are actually signals about what the different retailers are doing in order to juice sales, right? I mean, is this a signal or is that noise?
I mean, I think it's a sign that the consumer is becoming more kind of selective and careful in terms of where they're choosing to spend. I think that's something that we've been seeing kind of actually through most of the year. I think you've seen a consumer that is kind of choosing very carefully when they choose to come out and spend. This is something that our analysts have talked about at UBS. The kind of retail analysts have referenced this idea of coming out for holidays, but not necessarily maintaining that pace of spending. And I think that's the kind of key point here is I think when we look at the consumer where I think you can see that there is a group of consumers who are still flush with cash and kind of sitting on relatively healthy balance sheets. But I think, there is an increasing portion of the consumer that looks like they're under pressure, and that pressure we think could potentially increase, as we go through the end of the year and into next year. So I do think we're in this period potentially of adjustment for the consumer. But when we get into next year, that big, beautiful Bill Act fiscal stimulus we think could potentially help around tax season. So we're not outright pessimistic here. I do think there is some optimism to come as we go into next year, though.
Abigail Watt, thank you so much for being with us. Abigail Watt of UBS. I do wonder, Annmarie, this idea of that shopping cart, and I know that was just one anecdote, but we're all seeing that, right?
I've done that this morning already.
I mean, how much? But also they'll track your moves, and I wonder, is this AI at work, right? Are these sort of like little algorithmic spies out there that are looking for you?
True. It's something that could be done now when you online shop that you just can't track if you are brick and mortar waiting for individuals to come in. You're not going to follow them around the store and see them pick something up and put it down, but you can track them all day long and potentially remind them you only have 24 hours, 12 hours, 6 hours, and you're like, yeah, I do kind of need that. Maybe I do buy it now.
Although there are those people that do follow you around at the stores. Are you sure you don't need any help? And then you sort of wonder, well, I can't ignore them the same way I can ignore an email. You have to sort of engage. Anyway, I'm digressing. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. U.S. Special Envoy Steve Witkoff is heading to Moscow as U.S. and Ukrainian negotiators say they had productive discussions about a framework for a peace deal. The two sides discussed potential parameters for a ceasefire as they pored over a 19-point proposal that emerged in Geneva last weekend. Airbus facing new issues affecting fuselage panels of several dozen A320 family aircraft. The suspected production flaw is delaying some deliveries. This after the company was close to completing repairs on thousands of the same jets following flight control software issues linked to solar flares. Disney's Zootopia 2 won the holiday weekend box office. The movie brought in $156 million at the US and Canadian box office over the Thanksgiving weekend. The film achieved the highest global opening for any animated picture in Disney's history, with a haul of $556 million worldwide. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, setting you up for the day ahead, plus Oksana Aronov of JP Morgan Asset Management, as President Donald Trump says he has made his decision on the next Fed chair. This is Bloomberg Surveillance.
To me, the underlying question is what the market expects the Fed to do versus what the Fed should do. And this is important coming into next year. What's going to happen to the economy? What's going to happen to inflation expectations? Because, to be honest, there is zero chance that we're going to have inflation, core PCE coming close to the target before the end of next year.
That was Claudio Irigoyen of Bank of America talking about, yes, the Fed may cut rates next week, but don't look for them to aggressively cut in the following year. And inflation is not going to hit those targets. This morning, you're seeing equities futures just a bit softer to start the last week, the last month of the year. What we are seeing is the NASDAQ underperforming, down 0.9% following the loss last month. What we are seeing in the bond space is, yes, maybe the Fed will cut rates next week, and maybe next year there will be an additional couple of rate cuts. Nonetheless, that yield curve steepening has reasserted itself. So 2-year yields up 2 basis points, 3.5% on the long end. 30-year yields up now 6 basis points, 4.72%, raising a question about just what this means going forward about inflation expectations as well as the Fed path forward. Counting down to the opening bell, here's a trading diary for the week ahead. At 10 a.m. Eastern, we get ISM manufacturing data. At 4 p.m., President Trump signing congressional bills. And at 8 p.m., it is the blackout period, but Fed Chair Jay Powell is speaking at a memorial event. Tuesday, earnings from CrowdStrike. Wednesday, ISM services. And on Friday,
core PCE, which sounds great, but it's for September, so don't get too excited. Turning back to the Federal Reserve, President Donald Trump saying he's decided on his pick to replace Chair Jay Powell. Sources telling us here at Bloomberg that Trump's chief economic advisor, Kevin Hassett, is the frontrunner. Oksana Aronov of JP Morgan Asset Management joins us now. Oksana, wonderful to see you. Thank you so much for being here.
Great being here, as always.
So I'd love to start there. This idea that the Fed is likely to cut next week, that is currently what's being fully priced into markets. And there's a sense that the economy is unclear, that there could be actually a reacceleration earlier next year. How much do you think that those inflation expectations are underpriced right now, akin to what we heard earlier from Claudio?
Can I just make a parallel between the Fed and that overly eager store associate following you around the department store?
Please, go for it.
Incessantly offering help, even though their actions are just like confusing you. And I think that's what the Fed has done. They're trying to be overly transparent. There's a lot of dissent within the Fed is what we're seeing. And we also know the Fed has had a history of just frankly not being agile enough, right? Staying low too long. Now they don't have the data. So frankly, you know, their actions, as the kids say these days, are sus. And when we look at the lack of data and the data that we have had over the past, you know, couple of weeks here and there, it has been, you know, on balance, at least okay, right? Initial jobless claims came in lowest this year. The consumer is spending, even though consumer confidence seems to be declining, consumer spending seems to be okay. So what problem are we really trying to solve with this Fed cut? Because if the problem we're trying to solve is the one that's most talked about, which is affordability, that certainly hasn't happened since the Fed began this cutting cycle, because both long rates and mortgage rates are actually higher today than they were when the Fed began this cutting cycle in September of 2024. So I don't really see any reason for them to not stand pat here and just kind of see how the data develops. But of course, they are going to cut because of all of this turmoil that they're in. They're under a lot of pressure, politically and otherwise. And I think this cut is going to happen, and we'll see whether it's the right one. I think the data will prove them wrong as we head into 2026.
If they were to just stand pat and wait for the data to come in and then make a decision, basically a pause, with where the market is lining up for a decision, what is it, 99% now? Lisa's been tracking it all morning.
So widely as well.
Right, but right now, with the market basically saying that they are definitely going to cut, what kind of reaction would we see if they decided we weren't going to pause?
The market would not like it. I mean, equities wouldn't like it, bonds wouldn't like it in the short term, but in the long term, perhaps it would give the Fed some more credibility, which I think it is sorely lacking, frankly, and it would provide a real kind of a North Star that, look, the Fed is data-driven, and we don't have really decisive data, and so based on that and the data that they do have, the little bit that they do have, they're choosing to kind of abstain here.
When you say the Fed is lacking credibility, is it because basically they said they were going to get inflation down and they accepted 3%?
Well, yes. I mean, that's part of it, certainly. They are essentially trying to now create some sort of a dampener for their fiscal dominance that, you know, we are living through the age of fiscal dominance. And so Fed's, not just credibility, but their really meaningfulness, impactfulness is just less. And again, we're seeing that in the fact that no matter what they do at the front end, the long end, which determines everything, right, in terms of costs, is just not budging. And so I think it's really the fiscal side of the house that has to get its game in order. And on that side, of course, everyone knows what they have to do. They just don't know how to get elected after they do it. So, and that's a story as old as time. So the Fed is in a really tough place here. And I think the new incoming chair has not only, you know, the policy, the dual mandate, but also the necessity to kind of rethink perhaps even Fed modeling and how do they think about making these decisions so that there really is transparency and not just, you know, this Fed member said this, and so the market odds sway this way, and then someone else says something else, and the market odds go the other way.
So somebody could take a look at all this and say, well, I'd rather just invest in Apple, or I'd rather just invest in Microsoft, or maybe just OpenAI, right? So there's this question of how much we're looking at the credit space as a haven from some of these discussions. You describe credit as still standing in the kitchen with the lights off. off. Can you please explain what that means?
Not my quote, but I do like it because I think that the spattering of headlines that we've seen related to defaults or write-downs, I think that's just the tip of the iceberg. I think there's a lot of news that are going to continue to break, which is not to say there's not a lot of fantastic private credit deals that are out there that probably were originated earlier on, but particularly the deals from 21, 22, perhaps not the most robust vintage. And also you've now had this trend of, private wealth space adopting a lot of these. And so the question becomes how much investment tourism, as I like to call it, is there? How well is the due diligence that's being done on these? And so I think there's going to be a lot more news when you look at defaults on the public side, to the extent that we have any visibility into the private side. They are rising, but also distressed activity is picking up every year. So far this year, you've had $50 billion worth of distressed activity, and it's higher every year for the past several years. What does that mean? That means that this entire private credit ecosystem has created a way for companies that cannot refinance themselves to be taken out via private credit loan. Pay-in-kind activity is rising as well. So when you add all those up, you actually have a credit backdrop that's not nearly as robust as your sort of official default rate suggests. And one last point I'll make on that, BDCs, which are the daily valued vehicles consisting of private loans, which are perhaps one of the few ways for us to gauge what's happening on the private loan side, which is so opaque, they've completely disconnected from the high yield and the leveraged loan markets, which are, presumably the building blocks in terms of credit quality, and are off, double digits versus high yield markets that have done well so far this year.
So the whole idea of still standing in the kitchen with the lights off, you don't know what kind of creepy crawlies are going around until you turn the lights on. It's sort of the akin to Warren Buffett with the tide rolling out, and you can see who's swimming naked. Yes. And I just wonder, how do you range your portfolio with this? If you see potential downside risk for treasuries, you see potential downside risk for credit, and we're heading into a year where people are feeling uncertain about the AI story. I mean, what are you overweight?
So we very much like protection on credit here. Not because we see sort of any kind of imminent risk, but we do know that it's not a question of if, it's a question of when, right? I always say that everyone is obsessed with identifying the top of the equity market, which is pretty much impossible to do because equities move on sentiment and bonds move on math. And when you look at investment grade spreads and see that they have been wider 95% of the time in history, 97% of the time in history. When you look at high yield spreads, and they've been wider 95% time throughout their 50, 45-year history, this is the top, and it's just a question of when, not if. So we do like credit protection here, something that is incredibly inexpensive because most people are not thinking about it. Most people are thinking about how do I maximize yield here? How do I, get a little bit more yield into my portfolio, which, several years ago, getting what we're getting at the front end of the curve, which is still more than what you're getting at the long end of the curve, was fantastic. So we are staying defensive, not because we're not constructive on the economy, because we are. And we do think the economy will prove to be more resilient than is currently being priced in. But we realize that that's probably not a great thing for duration or interest rate risk. And also, credit has some real issues underneath, and we want to be protected to take advantage of that.
Oksana, wonderful to see you. Thank you so much for being here. Oksana Aronov of JP Morgan Asset Management. Coming up tomorrow, Cameron Dawson of New Edge Wealth, Apollo Global Management President Jim Zelter, Katie Kaminsky of Alpha Simplex, and Lindsay Piegza of Stifel. This was Bloomberg Surveillance, the first day of the last month of the year. Good morning.